earnings, but if you didn't upgrade your guidance, you got completely pummeled the next day in the market. And so how long can these companies maintain these growth rates? I think you make an excellent point about the fiscal impulse when it comes to all of this and the sovereign spending that's being funneled in. But at some point, I think expectations just become too high and you settle into some sort of sustainable rate of growth.
Can we talk about these outside moves that we've seen as well post-earnings? I know you can't do single names, but I'll tease some of them out. ARM is one, a move of something like 8% this morning. We saw a double-digit move in one direction on Meta, saw something similar on Tesla, other big tech names as well. What's the signal you take away from that?
So we actually crunched the numbers at the index level, and if you beat on earnings and revenues and increased your guidance, you were flat relative to the market the next day. If you beat on earnings and revenues but didn't upgrade your guidance, you were down 150 basis points relative to the benchmark. I mean, I think that tells you all you need to know is that expectations potentially have just become overextended for some of these names. Yes, nominal growth is robust in the United States, but as we talked about earlier, that's not inflation on top.
So, John, I also asked that question. Answer. He said these, like penny stocks, it's a liquidity problem, that people aren't really playing in this market. People have pulled back. Do you see any degree of that too?
I mean, you've definitely seen people step back from, it being all about tech, and you've seen the market broaden out. Financials in particular have been behaving quite well. I think that could well be a part of it, right? Liquidity always matters when it comes to those outside moves, but when we think about more of the fundamental story, right, these stocks were trading at valuations that were simply extrapolating current rates of growth, nearly indefinitely into the future. And we all know that at some point you need to land the plane, and I think that's what we're in the early innings of beginning to see.
I love what Pete said over the weekend. 10% is the new 1% for mega cap tech. We're talking about trillion-dollar names moving double digits, which is just unbelievable. Coming up next, breaking jobless claims data just around the corner, 4 minutes away. We'll catch up with Pooja Sriram of Barclays, here to react alongside David Leibovitz of JP Morgan Asset Management. As we count you down to a little bit of data in America, equity futures down 0.1% on the S&P 500. Yields are higher by a single basis point on a 10-year, 450.82.
enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Some data for you, just moments away. Equities right now pulling back by 0.15% on the S&P 500. A little bit lower on the NASDAQ. We're down by, let's call it 0.2% and round that down for you. Switch at the board and get to the scores in the bond market. Going into jobless claims, yields are a little bit higher at the longer end, up by 2 or 3 basis points on a 30-year at 466.66. And on the 10-year, 450.62, up by a single basis point. With jobless claims, Mike McKee, the estimate is 212. The number is
231. Kind of a surprise here. Remember me, I used to do economic data here, but well, we used to have data. First data point of the week, 231,000. That is quite a change from what we had in the previous month. The continuing claims at this point look like they've gone up. I'm waiting to get the change from the revisions, and they're at 1,785,000. The initial print last week was 1,774,000, so a slight rise there. Okay, 209 is the revision to last week, so we go from 209 to 231, and we go from 1,768,000 to 1,785,000. So not a huge rise in the continuing claims number, but a fairly big proportional rise in the initial jobless claims number. But we've been here before, so we have to see if this continues.
Yeah, we have. We've got up to these levels and then dropped back down towards 200K again. But nevertheless, the question will be asked at 231 versus the estimate of 212. What is the difference between a welcome cooling in this labour market and an unwelcome deterioration? Let's turn to the price action and start with equities. We'll turn to bonds and then get to foreign exchange. Equities are positive off the back of this and now just about unchanged on the session on the S&P 500. Bear in mind where the bond market was. Switch up the board. Yields were higher by a basis point or two at the long end, and now we're lower by about a basis point on a 10-year at 448.65. So we unwind some of that move. Likewise on a 2-year, down a single basis point to 482.17. So all of this is marginal stuff. If you get to foreign exchange, I can tell you the euro is erasing losses from earlier this morning, now just about unchanged at 107.44. So Mike, that is the question that will be on people's minds. Looking at a number that reads 231 against an estimate of 212, are we seeing a welcome cooling in the labour market or an unwelcome deterioration?
Well, unfortunately, with this high-frequency data, it's going to take you a number of weeks to find it out because, of course, it's the first time in a while that we've bounced up. Now, do we stay up? Are companies laying off more people, or is this a one-off that we have to figure out going forward? That's the hard part with this data.
I know we ask this every time, and, it feels like it needs to be asked again. What's the usefulness of initial job claims to give us any sort of signal value?
Only in a sort of aggregate over time period. On a weekly basis, it doesn't add a lot to it, but it does suggest if you see two things. A rise in the initial claims over a period of time suggests that companies are starting to get rid of workers because they see something that worries them. And a rise in continuing claims would tell you it's getting harder for people to find jobs. Now, we had this, as John said, a couple of weeks ago, and then it went away again. So you got to be extremely careful in deciding this is something that matters.
I would also add it's the highest frequency indicator we have for the labor market. And so if you're trying to keep your finger on the pulse of what's happening, it's arguably good to look at, even though it's a little bit noisy. What I think is interesting about the print this morning is, claims had kind of been sitting on one side with respect to being, very tight, running hot. You're seeing it moderate and move back in line with the broader set of U.S. economic labor market data. And so, Mike, I'd be curious from your standpoint, when you look at the U.S. labor market today, zoom out, think about all the indicators, non-farm payrolls, jolts, et cetera, where do you think we are from a slack perspective? Do you get the sense that the labor market is moving in the direction the Fed wants it, or do you think that we're still sitting here pretty tight and there's a bit more progress that needs to be made?
Well, both. I think that we're moving in the direction that the Fed wants it. Again, it's hard to tell from jobless claims, but when you look at jobs created, when you look at the decline in JOLTS openings and other indicators, it does suggest that we are seeing the labor market come into better balance. I don't want to sound like Jay Powell.
You do.
But even at this point, I mean, 175 in jobs is still a big number.
Right.
And so balance is a better word than getting rid of a lot of slack. And we're not really sure what's happening with all the immigration into the U.S. How many of those people are going into the labor force? Seems to be a lot of them that keeps us able to hire and helps hold down wage gains, but we'll have to see.
We're light on data this week, but over the last few months, there's enough data for everyone to construct whatever argument they want to make. Let's construct a really bad one of the US economy right now. It's easy to do. Let's take the data from last week, exclude the ECI, and go to payroll. Smallest gain in 6 months. Wages, slowest pace in nearly 3 years. Go elsewhere and look at the ISM. First contraction since 2022, below all estimates in our survey. Business activity slumping to a 4-year low. Input costs going in the wrong direction. 231 on jobless claims. We're starting to see an upside surprise there too. David, we could sit here and make this sound really, really gloomy and say Q1 strength, head fake. This is going in the wrong direction. What's the counterpoint to that?
So I think that the counterpoint to that is when you peel back the layers of the onion on the first quarter GDP data, you saw final domestic demand still very robust. And so, yes, we can interpret all of this as a beginning of, a cooling in the labor market, a cracking in the labor market. But, the counterpoint that you can make to that is we're starting from a very positive position. So unlikely the consumer just falls out of bed overnight. At the same time, you're seeing business confidence begin to pick up. You're seeing CEO confidence begin to pick up. That could well lead to an improvement in investment spending and manufacturing activity this year. And I don't think you would be getting that signal from the corporate boardrooms if they didn't perceive the end demand to be there. Now, I will admit, oftentimes when you get a couple of negative prints on non-farm payrolls, the NBER comes out and says, hey, you know what, we were in a recession, we just didn't know it at the time. And so that does always exist as a risk. But I think the fact that you're hearing business leaders continue to illustrate and remind us that demand is robust gives us confidence that the economy is unlikely to roll over.
Why do you think they're fragile, though? The narrative is so fragile over the last 12 months or so. If you think about where we've been, we've had hard landing, soft landing, no landing. Started this year, we had 7 cuts, we went down to 1, we brought a few back in. Why has that narrative been so fragile over the last 12 months?
So I think that it's a relatively simple answer is that, a lot of us have never been in a situation like this before. And, we went through COVID, we went through the pandemic, none of the economic models worked, all of our forecasting was completely off. And now we're kind of dealing with this reemergence of consumers globally that, a lot of people just don't have experience with. It was just a couple of years ago where people were talking about embarking on the roaring 20s, right? We're going to have this period after the pandemic
still are,
where
just for the record.
People are out and they're spending and they're consuming and it's about doing it today and not waiting to do it tomorrow. That narrative is completely faded, but frankly aligns pretty nicely with what we've been seeing over the past couple of quarters in particular. And so I think it's just unique, and that's the nature of where we are.
Let me also point out the Atlanta Fed came out with their latest second quarter GDP Now number yesterday, and it's 4.4%.
Right.
Now, it's really early, and that's really high, and that'll come down, but it is kind of funny that we're seeing signs of strength in some areas. The Fed is like a driver who's stepping on the brakes. They want to step on the brakes, but not so hard that they get rear-ended by recession. And at this point, they don't know. We're going in the direction they want because they've raised rates and the economy's slowing. How far? Did they do too much? We don't know.
Well, I think what's really interesting, if I can just jump in quickly, is if you look at high yield default rates, they've remained very low because a lot of these companies were able to term out their debt in a fixed rate fashion during the very low rate period of 2020 and 2021. If you actually look at bankruptcies in the United States, that number is rising. A lot of those businesses rely on floating rate debt. And so I think one of the things that gives the Fed a bit of confidence that they are applying the brake in the right way is you are seeing that impact of higher rates finally begin to filter through and show up in some of the data after a period of tremendous resilience.
That is something so many people have said. Look, everybody refinanced. We're okay now. It's okay if rates, stay higher for longer because everybody took out cheap debt. But that was in 2020 when the Fed started to cut dramatically. We're 4 years out, David. Are we not finally starting to face some manner of a maturity wall?
So you are beginning to face more of a maturity wall than had been the case. I think it's important to look, though, at the share of debt outstanding that the maturity walls represent. It's mid to high single digits for both high yield and investment grade. The real issue is in private credit, right, where that number is, call it 15% over the next couple of years. Now, private credit loves nothing more than to amend and extend and kick the proverbial can down the road. So will that lead to defaults? I mean, your guess is probably as good as mine. But what you've seen, and now particularly with the bank loan market heating back up, right, there's competition to do deals, and that's allowing people to address the higher interest rates we're dealing with today and not have that become a problem until some point down the road.
Well, then you get the scary thing of private credit to compete with the banks all of a sudden has to make these concessions, not charge as high as fees. So are we in this environment where banks are coming back in, private credit has done an extend and pretend? When the music stops, what does that look like with a non-transparent and somewhat unknown entity? So
it looks completely different than what we went through almost 15 years ago, because at the end of the day, the people on the hook are investors. And I'm not saying that makes it okay, but if you think about who invests in private credit, it's pension funds, it's endowments and foundations, it's high net worth individuals. And so it would be unfortunate if all these funds had a problem and people began to lose their shirts. But people who try to draw parallels to what happened in 2008, I just think it's apples and oranges.
If you are just joining us, welcome to the program. A rare upside surprise on jobless claims about 10 minutes ago came in at 231. As we like to say on this program, the wrong kind of upside surprise on claims. 231 against an estimate of 212. Going into the opening bell about 50 minutes away, futures were negative. Then they turned positive, just about unchanged on the S&P 500. Yields were higher. Now they're lower. We're down 3 basis points on a 2-year at 4.80. In the FX market, the dollar was stronger, flips weaker. The euro, 107.55. The euro now positive by 1/10%. Mike McKee said it straight out the gate. We haven't seen much of Mike because there hasn't been much data so far this week. This was the first data point. Tomorrow, we'll get UMich consumer sentiment expectations. Then, Mike, the big ones next week, PPI, CPI, US retail sales.
Yeah, we put it all into 1 week to make it more exciting. We're looking for a slowdown in inflation, and that's going to be the big story next week, and we'll be watching every day to see what Fed speakers have to say about that. Retail sales is very interesting. You got people who are all over the map on what's happening with sales. You got a lot of notes from people saying retail sales have slowed a lot. Bank of America out this morning saying that not only are retail sales holding in, they're not saying they're growing hugely, but they're holding in, but that they're seeing at the lower end of the income scale, which everybody's been talking about. The poorer people are all out of money, and so they can't spend anymore. That's not what Bank of America is seeing.
Let's talk about the setup. Can I just get into the setup for next week? Last week, we were talking about asymmetric risk. And what people were saying basically was that if the data's hot, yields won't rise too much because the Fed's not going to hike. But if the data's weak, yields can drop a whole lot more because this Fed wants to cut. That was when yields were at 5% on a 2-year. We're down to about 4.80. We've reset a little bit. Is there still asymmetric risk around this story into next week?
I think that there is, because if you look at the positioning data in particular, there is a massive short position sitting across the rates market today. And so I think part of why you saw rates come down so sharply in the wake of last week's non-farm payroll report was really just people adjusting to, okay, maybe the economy is getting a little bit cooler. Maybe we shouldn't be betting on going to 5. Maybe it's more reasonable to bet on going to 4.30 or 4.25. But to me, I always come back to where the MOVE index is, because it's important to think about volatility and what's being priced there. Yes, we've come off the boil, but we're still at elevated levels. And what that represents to me is simply a wider dispersion of outcomes. Again, back to where we started the conversation at the top of the hour, last week had some for the bulls and some for the bears. And so I think we just need to see more data, particularly this CPI print next week, to get a better sense of the broader direction.
I'm trying to do what I can for both sides.
Very kind of you, Mike. Can I take that same sort of logic, though, and apply it to equities? It was Michael Hartnett who, before the jobs print, basically saying if it's low enough, then it brings the stagflation fear. So in that way, bad news is bad news again. We got a lower print. We got a higher print for the jobless claims, yet equities, they're up. Are we not worried about that environment?
Eventually we will be, but I think we're still in the early innings of seeing the data really cool in the way that the market wants it to and the way that the Fed has been suggesting they would like to see it as well. We were chatting the other day. Yes, at some point here, bad news becomes bad news, but if you look relative to history, 175 payroll growth certainly isn't bad. 4% wage growth certainly isn't bad, and an unemployment rate below 4%, that signals a pretty robust labor market situation.
David, you're going to stick with us. Listen to these numbers. Bank of America Institute numbers are just out. Take a listen to this. Lower income household balances were 67% higher than the 2019 average at the end of April. Middle income household balances 58% higher, and higher income households 45% higher compared to where we were back in 2019. Those numbers are absolutely staggering. More on that a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. We're going to stick with real estate here because approximately 1 in 37 homes in the United States are now considered seriously underwater. Nationally, 2.7% of homes carried loan balances of at least 25% more than their market value in the first few months of the year, and that's up from 2.6% in the previous quarter. Kentucky, Mississippi, and Oklahoma saw the biggest increase in homes seriously underwater. And living in Manhattan is also getting more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 of the past 4 months, suggesting another record-shattering summer to come. And shares of Airbnb are falling in pre-market trading. The company posted revenue that beat analyst estimates but provided lackluster guidance for a second consecutive quarter. The company, which specializes in shared homes and vacation rentals, says it sees growth before slowing an uptick in summer travel. It's expecting revenue growth to re-accelerate in the third quarter, though, as key international events like the Summer Olympics in Paris and the Euro Cup in Germany fueled travel demand. And that's your Bloomberg Brief, John.
Shonali, thank you. Appreciate the work this morning. Thank you very much. Up next on the program, back to the bundle.
The other positive for us is obviously the streaming service. We're encouraged by the progress we've made in that business in a relatively short period of time.
That conversation is coming up next. Just moments ago, jobless claims coming in at 231,000 against an estimate of 212. Your equity market recovering just about unchanged on the S&P. The opening bell, 45 minutes away.
In tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Non-negotiable.
Ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep in World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We got jobless claims data moments ago. It came in at 231,000. The estimate was 212. That is an upside surprise, the wrong kind of upside surprise. And off the back of it, equities erased the morning's losses. We are just about unchanged on the S&P. Yields were higher. Now they're a little bit lower, down a basis point on a 10-year to 4.4845. Under surveillance this morning, it's back to the bundle.
The other positive for us is obviously the streaming service. We're encouraged by the progress we've made in that business in a relatively short period of time. We took prices up a little bit in the beginning of this year and didn't really see much of an impact. But we do believe that the great experiences we provide, people are willing to pay for.
So here's the latest. Disney and Warner Brothers Discovery announcing they will combine their streaming services into one bundle starting this summer. Subscribers will have access to Disney Plus, Hulu and Max, both the ad-free and ad-supported versions. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, we've talked about this for years now. The bundle's making a comeback, and I guess here it is. What's the price point of this?
We don't know the price point just yet, John, but yeah, you're absolutely right. What was old is kind of new again, right? And it's all about now creating this super bundle. For Disney and Max, this kind of makes sense. I mean, both their products together will definitely have four-quadrant appeal. And I think, why we're seeing this, I mean, there is a kind of a hint of desperation here from all of these media companies, because we know that streaming subscriber growth has kind of hit a wall. I mean, Disney is not really able to get beyond that 150, 160 million subscriber mark. And then if you kind of look at Max, which has been fairly successful, they really struggled to get past that 100 million mark. So this is about kind of reinvigorating that subscriber growth, but more importantly, curbing churn. Because one thing with streaming that we know is it's really easy to cancel your service, and they're hoping that this way they can kind of keep customers on the bundle.
Geetha, as Danny mentioned earlier on this morning, it's not just this effort. We're seeing it in sports as well. As you look at the companies that are combining, what is bringing those specific companies together versus, say, tie-ups with others?
Yeah, so, this particular instance, John, with the Disney Warner Brothers is actually, I think it's perfect timing, because it's kind of a good setup. You mentioned sports. They do. Both these companies, along with Fox, have that sports joint venture. So they do have a streaming product coming out a little bit later. They have now this Disney Plus Max product. Then they have the sports product. It kind of eventually sets up a path for them to have that super bundle, if you will. And I think that's kind of what they're aiming for here. And so far, what we've seen with bundling is that it does work. So Disney itself has said that about 40% of its streaming subscribers actually take the bundle right now. So that's, the Disney bundle with Disney Plus, with Hulu, and with ESPN Plus. So bundles do work. And that's kind of what they're betting on here.
What about the math of how it works for the company, Geetha? We learned that Warner Bros. Discovery wants to cut costs, wants to raise some of its subscription prices. What happens then if you need to offer a bundle and need to price it competitively to be the super bundle?
Yeah, I think they will. So this partnership here is a little bit different from what these companies have been pursuing. So what we've seen across up until this point has really been bundles more with the telecom providers. So we know like that we had that big Verizon bundle where you had, Verizon was offering kind of the bundle with Max and Netflix. Multiple telcos, you had T-Mobile with Netflix. There's obviously a revenue share agreement here. Obviously, what these companies are trying to do is by doing it themselves without a telco partnership, they're obviously trying to keep more of that profit for themselves. But yes, ultimately, it is going to come down to cutting costs. And this helps them to kind of really cut down on marketing costs. Because if you look at just marketing costs for all of the streaming subscription services, apart from content, marketing and selling expenses are actually one of their biggest cost centers. So this really helps them with that when they kind of pool their resources together.
And that's actually a perfect segue into the question that I wanted to ask. We've talked about subscribers, we've talked about price, we've talked about costs, but content is king in this space. And so how competitive do you think this bundled content will be relative to the other folks that are in the market?
I think that's absolutely what they're betting on. Disney obviously has its own appeal with younger children. HBO Max, as you know, is prestige TV. They're really kind of, and then Hulu right now is kind of getting into more edgy entertainment. And then with Max, remember, you have a whole bunch of movies that are going to come on the service, as with Disney Plus, once they release in theaters. And so that's really kind of what they're betting on here. I mean, you have two superpowers in terms of content IP, in terms of storied brands. And so they're really kind of betting on getting those brands together and appealing to a much broader section of the audience.
Geetha, this was great. It's always great to catch up with you. Geetha Ranganathan there, Bloomberg Intelligence, on the latest streaming effort, trying to get our hands around just how strong this consumer is. I want to go back over those numbers from Bank of America and their Bank of America Institute research piece. Lower income household balances 67% higher than the 2019 average at the end of April. Middle income household balances of 58%. Higher income households of 45%. David, can we talk about this? Obviously, the month of April can be skewed by, say, tax returns. But where is this US consumer? It's something we grapple with every single day. Jobless claims tell you one thing. You look at overall payrolls growth, it tells you another. You hear from Disney and the theme park business, everything's fine. McDonald's, Starbucks, we got a problem. Where are we?
So I think that the consumer is in a period of transition. And, when we look at the broad swath of data that we have access to, one of the things that you are seeing, particularly among lower income individuals, is trading down, right? So not buying the name brand of, say, paper towels or detergent, so on and so forth. But people are still very much valuing experiences, because it was experiences that were taken away from them during the pandemic. And so you're seeing a lot of spending continue, but the underlying profile of that spending has, in our view, shifted. I think what's particularly interesting about the lower income individuals, it all comes back to the labor market. If you want a job in this economy, you can go out and get a job. And if you look at the data from the Atlanta Fed, as to where wage growth is most robust, it's still in those lower income buckets. And so these people, the cash is coming through the door. Given their higher marginal propensity to consume, they don't save it, they don't invest it, they go out and spend it. And that's what's keeping the whole thing humming along.
And not only is what they're putting it in changing, but also how they're doing it. Sure, they can get jobs, but at the same time, the pandemic savings has run out. John and I were talking about this earlier. Buy now, pay later. A Harris poll found 43% of those who owe money to buy now, pay later said they were behind on payments. So as we get people shifting to this type of credit, sure, they're still spending for now, but when does the music stop?
So I think you're beginning to see that stress build, and I think it's all part of a broader story, and we talked about this a little bit earlier in terms of small businesses and floating rate debt, and that finally beginning to pinch. You have seen delinquency rates on credit cards and auto loans rise here. One of the things that came out of the great piece that you all put together on buy now, pay later was a lot of the folks that are engaged with those services also tend to have credit cards that are all kind of tied in together. And so you're seeing that leverage profile begin to build, and that's something that we're watching. I think that the conversation is shifting here from, okay, it looks like the economy may cool off. How much cooling are we going to see? And the big risk is if we see people continue to get over their skis, if you see consumers continue to lever up, if you see CEOs become increasingly confident and go for those capital expenditures, if you see vehicle sales, housing, right, the cyclical parts of the economy, if that begins to heat up, we're going to get a little bit nervous.
David, this was great. Just fantastic to have the hour with you. David Leibovitz there of JP Morgan. Bramo warned you at the start of the week. This week might be a little bit boring. Last 24 hours was 187.70 at the close on Tuesday, and then the close yesterday, 51.87.67. We've barely moved. Things are getting a little bit more interesting going into the weekend. Tomorrow morning, here's the lineup. Former House Speaker Kevin McCarthy will speak to Jim Bianco of Bianco Research, Anastasia Amoroso of iCapital, and Dan Suzuki of Richard Bernstein. Danny's going to be back tomorrow. We'll do it all again from New York. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. So how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
We do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Granny. Welcome to the show. To underwhelm means you get a big. The bookings are down at the lowest pace since 2020. Will the summer dragging a little bit on spoos? We've had a whip around in the jobless numbers. We'll count you down to the open and what it means in the data. Good morning. Coming up at the show, those initial jobless claims coming in hotter than expected, sending futures and treasuries off their lows, injecting fresh life to the rate cut debate. We begin with a big issue, looking for the next catalyst.
There's been a cocktail of bullish catalysts here recently, getting to earnings season. Buybacks, blackouts came off, and there was just a lot of, just temporary tailwinds here for equities that kind of propped us up. But I think we're facing some resistance here around some moving averages, and once the market comes to grips that the Fed is not ready to hike, especially if not ready to ease, especially as we see CPI next week, which is expected to be fairly hot. I think we'll probably retrace a little bit to the downside.
A cocktail of bullish catalysts are set to fade. Are they? Katie Kaminsky of Alpha Simplex and Colin Martin of Charles Schwab are with me to debate that narrative. Katie, good morning. Are the bullish catalysts set to fade, and have equities yet to meet their reality check? Good morning.
Good morning. Yes. I think, sorry, I didn't understand that you were asking that question, but what we're seeing right now is a very bimodal positioning across different asset classes. You're seeing that equity signals are still holding ground, but if you look cross asset, fixed income signals continue to be short, and you're seeing some steepening in the yield curve, and you've also seen a tremendous rally in commodities in the recent months, something like oil prices. You've even seen food prices start to pivot recently as well in terms of the raw products like wheat, corn, soy. So you're seeing two different narratives, one that's saying sticky, higher for longer inflation, and then the equity market's trying to digest how serious is this for us. So hence the CPI is going to be really important next week.
Yeah, I think the debate on just how hot that is something we're going to work out. Colin, good morning to you. Bonds have had a recalibration, a little bit of a pip higher and a turnaround on these jobless numbers. But when you look at the bond market, do you think that momentum is running out of breath on the recalibration of a drop in yield?
I think it is. We think yields will probably remain range bound for a little bit until we get more evidence that the disinflationary trend will continue. We are seeing plenty of signals in other sorts of data that support the view that inflation should slow from here. But I think until we get more evidence in the actual numbers, so like next week CPI in the PCE numbers, and not just next week, but over the next month or two or three. I think until then, and until we get evidence that cuts are coming soon, we might see yields trade in this range. We think over time they should move lower, but until we get that disinflationary catalyst, they might remain range bound.
Yep, all eyes down for next week. It's going to be fairly definitive on additional information on the inflation front. We've just had some data this morning. Let's catch up with Mike McKee. He's side by side with me here. So the jobless claims 231, Mike. We're going into a 30-year government auction, and not to be outdone, you've got a little bit more data coming tomorrow. Good morning.
Good morning. Well, there is a lot of concern about whether the U.S. economy is slowing or not, and the jobless claims would seem to suggest that. You look at the initial claims, 231, as you mentioned, running well above the year-to-date average last week. Continuing claims are just about at the year-to-date average. They were up as well. Is this a sign that the economy is slowing, the labor market is loosening, and we might face recession down the road? No. And here's why. You take a look at what's been happening with jobless claims, and you go into the history of it. And it's a little hard to read on this because of obviously 2020 skewed everything. But you can see the green line is the average of jobless claims over about 50 years. And yes, jobless claims rise when you go into recessions. And we're not rising right now. We've gone up just a little bit, but you can see how far that white line is below the average still, even at 231. So what happened? New York school kids went on vacation the last 10 days of the month of April. So the first week in May, which is what the numbers are counting today, show that all the people who are eligible in the school system to file for unemployment did so. Expect a drop back next week. What does it mean for the Fed? Well, nothing there, but their attitude is pretty much all the same. Everyone's singing from the same songbook, including Susan Collins from Boston yesterday, saying the recent data lead me to believe this will take more time than previously thought. That is probably the case, so we kind of put that aside, except for the fact that the Fed on hold is a problem for the rest of the world. And I go back to the old saying about it's our dollar, it's your problem. And it is a problem for everybody else. You can see I normalized the changes here. Mm-hmm. Currencies, the pound, the euro, and the yen inverted there, have been dropping because the Fed's been raising rates, and you get more money and more interest in the United States than other places. We saw that today. Bank of England on hold, but everybody thinks they might cut, so the pound goes down. And at this point, this is a problem for those countries, but it also starts to be a problem for us. If we continue to have problems selling exports overseas, it's going to hurt the manufacturing numbers that we might have seen a little bit of in the ISM last week.
Nobody wants to challenge that strong dollar policy, do they, Mike? Let's see until it bites in the proverbial. Now, you mentioned the Bank of England, Mike, so it's worth just checking in some of those cross assets this morning. You've got sterling back to flat 124.95. The Bank of England Governor Bailey, who we'll sit down with a little bit later on, he's optimistic that things are moving in the right direction. A rate cut in June is neither ruled or planned. And there was a bit of a shift. The Deputy Governor inside the Bank of England moves and joins the external member, calling for an immediate cut. So the narrative is building on that. Euro slightly better bid against sterling, and 10-year yields flat at the moment, but a great deal of the dovishness was already in the price. Katie Kaminsky and Colin Martin are my guests this morning. To the global aspect of this, there's the Bank of England sounding more dovish. The Riksbank cut. The ECB are presumed to cut earlier. We are moving towards a global rate resetting narrative, Katie. How important is that for overall growth momentum to sustain? Because it does all feed back and wash back into the US at some stage.
Yes, and I mean, I think it's important you bring this up. And if you look at those economies that have already started to push more towards cuts, they're seeing less growth than what we're seeing in the US. And that's why there's definitely a much more tricky picture, and it might take a little bit longer for the US to be able to cut rates. The market wants it. I think the Fed wants it. But in general, the data hasn't shown yet. We also point out, if you look at countries like the UK and Sweden, example, they have a lot of floating rate mortgages. So they have definitely seen a bigger impact in their housing sector than we have seen in the US. So I think there's just differences across these countries where, in terms of how quickly they're going to be able to normalize rates.
Look, absolutely. And the argument is here in the United States, everybody, not everybody, but a great many people went through the remortgaging process at those lower rates. Colin, you know, the Fed could be the last central bank standing, the last hawk standing. And that has got consequences on differential trades, on Treasury bonds, on Treasury against other government bonds, and also for the dollar as well.
Yeah, that's right. If we look at the global bond landscape, the gap between U.S. yields and global bond yields has rewidened recently, and you know, I think that's one thing that could keep a lid on our yields should we get some upside economic surprises where there might be some foreign buying, especially if we get closer to those 5% levels on intermediate and long-term bonds. I think that's a psychological level that a lot of investors are interested in. So I think that's important. Going back to your comments about the dollar you know, has been strong. We saw it drop a little bit this morning with the initial jobless claims number, but there can be benefits to that in terms of inflation, where it does negatively impact exports, but it can positively impact imports. And we know that we're trying to bring inflation down, and the stronger dollar can help that to a degree in terms of import prices.
Colin, just before we move on, what is it that retests 5% in the 10-year government bond yields? Because we've had, as I say, this recalibration. It's my favorite word at the moment. But what is it that spooks me back to 5% on 10s?
Well, I want to make it clear, it doesn't spook us. We don't think it's happening. But what could happen if the economy were to not just remain as resilient as it is, but really reaccelerate, and then we'd likely need to see a reacceleration in inflation, even just modestly, which would reprice expectations for the Fed to not just be a higher for longer policy, but actually start to see more rate hikes coming down the pipeline. Doesn't seem likely right now. Most Fed officials, with the exception of one or two, have generally pushed back against that. Markets don't really believe that. So as long as the next move is expected to be a cut, we don't really see long-term yields really getting back to that 5% area.
And Katie, for you, I mean, as Colin says, look, that's not his base case scenario. When you take the narrative, it is that they want to cut. They just want more time to understand, to recalibrate, to be cautious, to let it be bumpy. As you look at the equity market landscape, we've had a lovely run. We've had this slight pause. So what is it that would get you to deploy more into equity before rate cuts?
Oh, that's a really good question, because frankly, we've seen such a big move that we need to kind of see resilience. We need to see that we can waver through this. So we need to see good earnings. We also need to see relatively resilient labor data. We need to see that things are still sort of safe and we have a way to navigate through higher for longer, such that we're not seeing deteriorating financial conditions. Right now, it's still looking relatively bullish on equities, but whether or not you're thinking about entering, it's got to be something to make you pause, given exactly what Colin said. I mean, just thinking about the fact that you could start to see a steepening in the yield curve. We have seen a little bit of that recently. And so I think that has made people a little concerned that, you know, this inflation narrative could be even stickier than they would like. And thus, you know, it's harder to navigate for equities, making that more questionable.
And yet, without sort of putting you into the box of talking about specifics, I look at overnight what has happened with Airbnb. That's consumer. Uber, that's also pressure. Disney, subscriber numbers, parks were resilient. But at Starbucks, at McDonald's, there are... If you underwhelm, if you underperform, if you underdeliver, you really are getting a pretty big pressure pushback from the market, aren't you, Katie?
Yes, I would agree. I mean, if the consumer starts to waver even more, that would definitely be something to be concerned about. That would eventually trickle into growth and will affect company earnings. And then you'll also see more sort of ammunition for the Fed to actually act. So I guess that would be something that might be pro rate cuts sooner. So I think it's bad news is good news on the consumer side, but hopefully we don't have that.
We're always trying to sort of find out where the next risk is, whether it's systemic or idiosyncratic. I'm just wondering, we wrote the big take, not me, but the team here at Bloomberg, and it was about the phantom debt, the buy now, pay later. And anybody who's lived through 2008 on the mortgage crisis, anybody who's lived through 2000 in terms of the dot-com bust. Colin, what did you make of the buy now, pay later? I mean, the Fed doesn't seem to be too worried about private credit and those kind of areas, but buy now, pay later, some of the numbers are quite chunky.
Yeah, I saw that article yesterday. And what I guess makes me a little bit nervous is that we don't have a full picture of what's going on underneath the surface. So if it is, in fact, a really large amount of debt that's out there that we're not seeing in terms of what consumer credit looks like, then that would be a risk. You know, what I think is a good thing, if we look at the data that is available, we did get consumer credit earlier this week, and it rose at a pretty small amount, especially with credit cards and that type of revolving debt. And I think that's a good thing, because if we look at what's been powering the economy lately, the consumer remains strong, consumption remains strong. But if we do see a slowdown in credit growth, I think that's a good thing and more good news for a potential soft landing.
I think the number here, I've just opened the story, $700 billion globally by 2028. And that's all grand if you're in a job and you're earning a solid level of remuneration. And of course, on a repurposed mortgage at about 2%. Life is sweet. Katie, thank you very much. Katie Kaminsky and Colin Martin, my guest this morning on the market. Let's look under the hood ahead of the opening bell. Abigail Doolittle is with me side by side.
And let's have a look at that one stock that you were mentioning. Well, several stocks you were mentioning, but one of them being Airbnb. Shares down sharply, heading to the worst day in more than a year. This, of course, after the guide was underwhelming for a second quarter in a row. Weaker demand as revenge travel fades. They are projecting the slowest growth since late 2020. As for some other movers on earnings, ARM, the chip holding company, beat, but the guide was viewed as a little light. Folks wanted a bigger boost given the AI component. Also fears that maybe there's some sort of an AI slowdown on this. The stock down 6%, but it should be noted up 40% into this report on the year. Roblox plunging, a record decline, heading to a record decline, down 25% in the pre-market. The online games and entertainment company is plunging on their weak second quarter outlook. But there is one winner here, and that is Bumble, up 12%, a huge first quarter beat. They also reaffirmed the full year guide. Now the stock into this report, man, is down 30% on the year. There is also a 13% short interest. So I think that some of this move higher for Bumble in the pre-market and perhaps on the open has to do with the short squeeze.
Okay, nothing to do with love lives eternal. Abby, thank you very much. Abigail Doolittle there with the very latest on stocks. Coming up, President Biden, he warns on Israel.
I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
That conversation still ahead on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
They go into Rafah. I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks. But I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
A stern warning from President Biden to Israel. The remarks came as the U.S. paused the delivery of over 3,000 bombs to Israel. The White House is concerned over the damage that they would do to the city of Rafah. Israel's finance minister responding to Biden saying, quote, "We simply have no choice as this war is an existential one, and anything other than complete victory will put the existence of the Jewish state in danger." Amory Hordairn joins me now from Washington. Amory, I look at this statement from the Israeli side. I look at the Defense Secretary, Lloyd Austin, saying at Congress testimony yesterday, there have been too many casualties in this battle space. Here we are with an escalation from rhetoric and pulling back on some bombs that the United States were going to deliver yesterday. So this is a shift, the gravity of the shift from the White House. Good morning.
Good morning, Manus. And I spoke to Ed Mills earlier this morning from Raymond James, and he was talking about the fact that this is as close to a red line as Biden has been. One of his most vocal warnings on Israel in this interview yesterday evening. When we were talking about this yesterday, we really were talking about a pause and that no decision had been made at the White House. But then following this interview, it does look like that pause is almost definitive when it comes to whether or not these bombs would be going to Israel. Biden has been concerned, and he talked about this, about the civilians that have been killed, Palestinian civilians that have been killed in Gaza. And what is so concerning to the administration, of course, is how densely packed Rafah is with more than 1 million Palestinians there. There's also, of course, which we talked to Ed Mills about as well this morning, and he pointed to the fact that we are 6 months out from the U.S. presidential election in November, and there's been a tremendous amount of domestic political pressure, especially from the youth. We've seen this across the country at college campuses, on this administration to take more of a defiant tone when it comes to the Netanyahu government. We should also note, Manus, that yes, this is potentially a fracture in the relationship, but we have been here before in the past. There is historical context for this. It is rare to see this kind of break, but it's not unprecedented. We saw it with Obama, we saw it with Reagan, with Nixon, with H.W. Bush, and that is where this relationship is right now. But Biden, this warning was very clear yesterday. Israel will not be getting those bombs.
How much of this pressure, Anne-Marie, is because of the college campuses? You go back to the apartheid era, which is where that level of social unrest in youth protests against apartheid was brought to bear by divesting from South Africa. Many people are drawing comparisons with that for Biden. He's under pressure. We're running up to this election. The youth are important. To what extent is the domestic imagery pressuring Biden to exert more force on Bibi?
Well, I think there's just really a divide with some members of the Democratic Party, especially when you look at the progressive left. A lot of that is the youth vote, but also even outside the youth vote, even some concerns with Democratic senators, as well as clearly with a lot of some congressmen and women on the Democratic side that want to see more restraint when it comes to Netanyahu and how they are going after Hamas in Gaza. So there's been a lot of political pressure within Biden's own party, which is why this has been so challenging. Because in that same interview interview, he talked about how it is important to secure Israel, how it's important to make sure that they have the Iron Dome. He's talked about his ironclad support to Israel, but at the same time, he's also talking about not sending them some of the ammunition that the Israelis say they would need. And we haven't heard from Netanyahu directly, but I think members of the War Cabinet have made very clear their displeasure with this. This is the tricky line Biden is walking, and until this is resolved in Gaza, this is going to be the tricky line Biden will be walking until November, Manis.
Indeed. Anne-Marie, how would you describe the nuances? There's been daily, sometimes over a series of weeks, conversations between Bibi and Biden. A lot of people question the ability of this administration to exert real force. They say if somebody else was in the White House, it may be a different scenario. Does that narrative hold? And to what extent is America still got the ear of Netanyahu? Or is that power and that influence seriously waning? And that's what's being said internationally rather than domestically.
I think what you see is that there's been a growing divide, especially since October 7th, when we saw this terrorist attack by Hamas in Israel. Biden flew to Israel, embraced Netanyahu. They were talking almost daily, then weekly. And now those conversations, even though there recently was one between Netanyahu and Biden, those conversations have become a little bit more sparse. What we do see, though, is that Bill Burns, the head of the CIA, is still in the region. And something the U.S. is trying to exert and trying to potentially even maybe use what's happening with this weapons suspension is they would like to see a ceasefire negotiation come to fruition. And at the moment, they are still committed to that when you have the head of the CIA remaining in the region to try to work this out. He met with Netanyahu, Ron Dermer, and other Israeli officials yesterday, and I believe today he'll be in Cairo to continue those negotiations.
Okay, Anne-Marie, let's see where this story evolves to. Anne-Marie Hordern in Washington. Coming up, your morning calls a little bit later. Jay Poloski of TPW Advisory joins me after the opening bell.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let's get you up to speed with your morning calls from Wall Street. First up, Deutsche Bank lowers the price targets on electronic arts to $150. The firm keeps a hold rating on EA, saying that the company's multi-year guidance shows margin potential. Next up, Accountability Research raises the recommendation on Shopify to a hold. The online retailer yesterday reporting earnings that topped estimates. And finally, Raymond James upgrading Cheesecake Factory to outperform, saying the results were strong despite the softening trends in the industry. Nothing beats a chunk of cheesecake. We're going to catch up with PW's Pawlowski. That's next after the opening bell.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Since we had the jobless claims, and we've trimmed our losses as that number pops a little bit higher. We can argue as to whether it was idiosyncratic and to do with the holidays and people claiming jobless claims. Right now, we're back to flat. 52.12 is where we stand, and on the NASDAQ. Keep an eye on Airbnb. It's been a real drag on this market, but we'll take you through that story in just a moment. In terms of the rest of the markets, cable is back to flat as we see a dovish tilt really from the Bank of England as the Deputy Governor goes on site calling for a cut. How much of that was already in the price? The dollar still remains fairly resilient. 10-year yields virtually unchanged, 450. We've got a 30-year government bond auction coming down the pike today, $25 billion worth of an auction. And there was a tepid demand for 10s yesterday. 2.49 was the bid to cover ratio. Crude ticks up by 0.25%. So some stocks that we're keeping a close eye on. Beyond Meat, despite the price hikes, the plant-based company, margins came under pressure from higher manufacturing and material costs. A classic story. Abby has the detail.
And on this, we have investors pretty rattled. The stock down 9% in the pre-market, down 14% at that point, the worst day in about a year. So investors not liking this report where they essentially missed estimates for the first quarter, EBITDA coming in a little bit light. On the other hand, what's interesting here here is that they did actually maintain the full year guide. So there's a greater than 30% bearish short interest on this stock, suggesting that maybe some of those bears taking the idea from some of the analysts that it's not clear what's ahead. In fact, we have William Blair saying that they cut their 2024 EBITDA estimates to reflect that softer gross margin you were talking about, and that it's uncertain where this is going to lead them over time. But again, Menace, they did actually maintain the full year guide, and some analysts, other analysts, including Jen Bartashas here at Bloomberg Intelligence, saying that the resets in various geographies and culling of different products may actually be an encouraging sign. So it seems as though there is a bull-bear debate on this stock, but right now the bears have it down 12%. Again, I would note that there's a massive bearish short interest on this stock. Probably a lot of this, those bears pouncing.
Abby, thank you very much. Let's turn over to travel. Airbnb, as I say, giving lackluster guidance for the second straight quarter. On week outlook ahead of the summer season, will that save them? Alex Semenova, for now, the market is not happy. Good morning.
Good morning, Manus. Yet another instance this earnings season of a company beating on earnings but disappointing on guidance, and investors really punishing the stock for that. Shares of Airbnb are down about 6% this morning. That's the worst since October. This is even as it doubled net income from the year-ago period and beat on earnings per share for the quarter. That outlook, though, indicated that growth in travel is slowing ahead of the peak summer season. Airbnb projects revenue in the second quarter between $2.68 billion and $2.74 billion. Analysts on Wall Street had expected the higher end of that range. Evercore ISI said revenue and adjusted EBITDA were bright spots in the report, but the revenue forecast bracketed the street. And in its statement, Airbnb blamed the earlier timing of the Easter holiday this year, as well as currency headwinds for this disappointing outlook. Airbnb and its rivals, of course, have been trying to reach a new normal after the COVID-19 pandemic, but the recovery has been really choppy, with growth recovering in some regions while tapering off in others. Last week, Booking Holdings gave a worse than expected outlook, and Expedia Group disappointed on earnings as well. Manus.
Alex, thank you very much. Alex Semenova there. On fintech, Robinhood reporting a second straight quarterly profit as higher interest rates and cryptocurrency trading fueled the revenue growth. Katie Greifeld has the details.
Well, like you said, a second straight quarterly profit. Also, Robinhood beating and posting records on a number of different metrics. Let's go through some of the numbers right now. Net income for the first quarter, that totaled $157 million, or 18 cents a share. For context, analysts had been looking for 6 cents, so a big beat there. And you take a look at a year earlier, actually, that was a loss of $511 million, so a big turnaround there. When it comes to revenue, net revenue climbed 40% to $618 million, and cryptocurrencies revenues there surged 232% to $126 million. And when it comes to cryptocurrencies, remember, of course, earlier this week you had Robinhood saying that they received a Wells notice from the SEC warning that the firm faces enforcement action over its crypto business. So a potential concern there, but you certainly don't see it in the stock this morning. Currently higher by about 8.5%, and going into these numbers, the stock had been higher by about 40% year to date. So really building on that momentum today, Manus.
Okay, Katie, thank you very much. Stock rocking and rolling there. On the consumer space, Tapestry cut its full year revenue outlook after sales decline in North America signaled weak demand. Isabel Lee has the latest on the retail narrative. Isabel, what's the story?
Hey, Matt, shares are edging lower by 3%. So Tapestry is the parent company of many brands we know, including Kate Spade, Coach, and Stuart Weitzman. And the company cut its revenue forecast and trimmed its full-year forecast to $6.6 billion. That's well below estimates. Revenue also fell more than expected, dragged down by sales from Kate Spade and Stuart Weitzman, which just really struggled to gain consumer traction, especially when it comes to their accessories line. We have revenue at Kate Spade falling 6% and revenue in Stuart Weitzman falling around 18%. Over at Coach, things are a little bit better because revenue is flat. Sales at the company, its average prices of handbags, which is a metric closely watched by investors because this is a revenue driver, was up. So at least there's that tinge of good news. But overall sales in North America and China are down. And for now, shares are really edging lower by 3%. Year to date, the stock has gained, though, around 5%, but still underperforming the S&P 500, Manus.
Isabel, thank you very much. Our next guest writes this. We're in the early stages of an earnings upcycle, and that will support global equities. And note double-digit EPS growth forecast for the U.S. equities this year and next. It is Jay Pawlowski, CIO, co-founder of TPW. Jay, good to have you with me. Look, it's great to have that kind of an outlook, but if you miss or remotely miss Intel, underwhelming, under the midpoint, Uber, underperforms. Starbucks, Airbnb, I mean, if you miss at all, there's severe penalties. Are you still as convicted on the earnings outlook after the sprinkling that we've had over the past 5-6 days?
Yeah, Manus, you make a good point, and great to be with you. And I think it's important to note that your point actually reaffirms the idea that we're not in some sort of bubble, right? We actually have a market that is discerning between winners and losers, and that's actually a good thing. And when you gross it up and look at the market as a whole, 81% of companies reporting to date have beaten estimates. That's much higher than normal. Usually that beat is around 70%. And even more importantly, if you look at the next 12 months earnings expectations, they are rising. And in fact, last week, you had the biggest jump in next 12-month earning forecasts in the last 3 years. And so analysts listening to companies are guiding and raising their estimates higher. And so when you have earnings estimates going up, and you have stock buybacks, by the way, running at about a 15% year-over-year increase, stocks are not going to go down.
I like what you say there, which is, you know, there's resilience. We're not in a bubble. The credit card spending, I'll come back to that in a moment. The Bank of America report, very, very strong consumer spending. So maybe it is in individual stocks we are becoming more discerning. But I love what you say about the Mag 7, and this is it. The penny dropped during several of the Mag 7 reports. Massive spending plans, roughly $45 billion apiece for Alphabet and Meta, and a strategy of spend like crazy now to monetize like crazy later. And it really does personify, you know, how Microsoft and Alphabet were rewarded. Meta asked for patience and they were lambasted. When you say that we're not in a bubble, how would you define where we are in Mag 7, which is a critically important part of the overall equity narrative?
Yeah, I mean, I think Mag 7 is pointing the way to kind of a winner-take-all, big moat type environment in the tech space. And so we're really focused, actually, though, Manus, on the idea that we're entering an age of investment, right? You look at those Mag 7 reports, they're talking about in spending, cap spending next year of 45 to 50 billion. AI is absolutely critical, right? Every country, every sovereign country needs their own AI. Yeah. Every AI requires lots of semiconductors. So we want to own what we call the picks and shovels in this space, and that's primarily in the digital space. That's the semiconductor stocks. And then interestingly, and this is happening super fast, I've been in this business a long time, and the speed at which things are moving is just really incredible. And we're fusing the digital space with the physical space through the demand for power. And so we think we're setting up for shortages in things like copper, because we're expanding the digital space much more rapidly than you can possibly expand a physical copper mine. And so we want to own the picks and shovels in both the digital space, that's the semiconductor stocks, and in the physical space, and that's the miners. So copper miners, uranium miners. We think there's a tremendous opportunity. And so you mentioned credit card spending. We have fully employed consumers spending, driving consumption, and we have an age of investment fueled by cash-rich companies and governments who are ready and willing and understand the necessity to spend on things like AI and climate. And that is a very robust outlook for the global economy, underpinning our view that we're in the early stages of a multi-year blue sky period for the global economy.
I mean, that's not just Goldilocks on her own having a good hearty breakfast of a bowl of porridge. That is the whole world coming to feast. I want to dig into this. I'm a believer. You've sold it to me. I want to dig into this Bank of America report. They talk about consumer spending being at 1% year over year. This is in April. Take out some of the noise of Easter and one thing and another. That is following a rise of 0.3%. So we're on the extend and pretend. We're putting it on the old plastic. Lower income spending remains above higher income households. That's probably a classic. But this consumer is strong. Consumer is spending. But is there anything worrying in that? In that consumer spending on credit is rising? Is it the last breath of the consumer, or is it, don't worry, they've got jobs, they're being well paid, and you're being overly zealous, you're being overly negative on a read on this spike in credit card spending?
Yeah, I would take the former versus the latter. I think this is not really a big issue. Household net worth is off the charts, right? Record stock prices, record housing prices, fully employed consumers, real wages growing after inflation. You look at the Atlanta Fed nowcast for Q2, just came out yesterday, 4.2%, Manus. 4.2%. Consensus for Q2 is 2%. Okay, so you're talking double. Now, we know that nowcast moves around very much, and we're not saying that's a set in stone number. What we are saying, though, is there's no sign that that there's going to be a massive round of layoffs, right? You have that demand side picking up. That's now driving through inventory restocking to the production side, the manufacturing side. And we wrote in our latest monthly, which you've quoted very generously, about a manufacturing revival on a global basis, actually using the same Bank of America source for that work. And so we're not concerned. The liabilities versus household net worth is actually at a very low number on a historical basis.
I would just give the qualification, just to make sure that I'm representing Bank of America fairly, is that the lower income households, after tax wages, which plays to what you said, salary growth has risen while the savings buffers remain. So even though we talk about the post-pandemic savings numbers dwindling, there's something different in these numbers. If I take that entire sweet spot that you've just painted for me, then maybe we're not restrictive enough, and maybe we need a hike.
No, I think, look, the Fed took the hikes off the table, and that's the right approach. We're in a global rate cutting cycle.
We are.
You just saw the Bank of Sweden cut, so the G10, the big developed economies are starting to cut. That goes along with the emerging markets that are starting to cut. And it actually raises a key point for us, Manus, and that is we're starting to sniff out signs of a change in global equity leadership. And I'll just point out that ACWI ex-US, emerging markets, amazingly enough, and Europe have all hit new 52-week highs in the last week, while the S&P remains 1% to 2% below its 52-week high. And so we're watching the dollar very carefully here when you talk about rate cuts and rate hikes. We're watching the dollar very carefully. We think the dollar is ripe for a rollover, for a decline, and we think it could be like a momentum type decline, as you've seen in markets around the world, commodities, et cetera. And so if that is true, that would reinforce this idea that emerging markets, led by China of all places, is actually starting to pick up the baton and provide global equity leadership, which has not been the case, for more than a decade. That would be a major, major sea change for global investors.
Okay, preparing for that rotation. It's already happened, as you say, with Europe and with emerging markets. It's whether that accelerates. Jay, thank you so much for being with us this morning. Jay Poloski of TPW Advisory. My guest this morning on the markets. We've talked about Airbnb. Are you booking? Will the earnings signal a slowdown in the consumer?
We're not feeling a lot of consumer pullback. I think our forecast is travel will be solid. As I said, just a slightly decelerating environment.
The conversation next on Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
We're pretty confident travel is going to remain strong. There may be some trades as consumers trade out certain things, but there's lots of ways to make their dollars go farther if they're focused, if they come to the right place. And so we feel really good about that positioning. And we're not feeling a lot of consumer pullback. You know, I think our forecast is travel will be solid. As I said, just a slightly decelerating environment.
That's the view from the Expedia CEO, shrugging off the concerns about the consumer. This as Airbnb raise new red flags. Well, the company posted disappointing outlook, suggesting a slowdown in travel demand before the peak summer season. Is that what really is behind the story? Mandeep Singh is from Bloomberg Intelligence. Mandeep, you know, the data in itself shows a little bit of a lull before the summer spike, but you would say it's possibly a little bit more about saturation and maturity of the product, is it?
I think so, and given, you know, how big of a bump we saw with Airbnb during the pandemic, I mean, remember longer duration stays, people were staying more than a month, sometimes 6 months at Airbnbs during the pandemic. So they got that bump, you know, in terms of their core room night book. And that is the metric that seems to be decelerating, even though they're doing a lot of things on the product side. I mean, Brian Chesky emphasized a number of new product initiatives, but nothing seems to be moving the needle at the scale where they're at. They may be actually close to 500 million room nights by next year. So that's a pretty big number when you think about, you know, their category leadership position in alternative accommodations.
Tell me this, does it need AI to really move the dial? What is AI in Airbnb?
Well, so Brian talked about using an AI agent to book your travel. I mean, think of how we interact with the apps and websites. We go and punch in all the data, do our searches. What if there was a fancier way to engage with an AI agent that could do this? I'd
appreciate it. It would help me get through all the various filters a lot more quickly.
And so on the product side, they seem to be doing a lot of things. It's just it doesn't show up in that top line growth yet. And that's what market wants to see.
Yeah, the market is hungry for delivery on time. Mandeep, thank you very much. Mandeep Singh. Now, there's another stock that we're watching. It is Warner Brothers Discovery. The company reporting sales and profit that fell short of the expectations due to low TV ad sales and poor performance at the movies. Geetha Raghunathan is tracking this story. So Warner put it in a resilient front this morning. But Geetha, talk me through the background.
Yeah, so with Warner, Amanda, so this kind of really epitomizes everything that we're seeing in media right now. So you have the TV networks business, which brings in about 50% of the revenue. But remember, that's 85% of profits. And as you just said, TV advertising is in a very, very tough spot. We saw TV advertising decline about 11%. That caused about a 19% decline in EBITDA. The good thing, though, for Warner is that they are showing some good momentum in the streaming business. Remember, this is the storied HBO Max product, so they had some subscriber gains. They're showing some positive profits, and this is the new guideline metric that is kind of very, very important. So it looks like they can get to profitability there. The only problem is that the streaming progress is not going to be enough to offset the decline in the TV network business. And the other big thing that we're kind of watching for with Warner is this pending NBA deal negotiation. So they currently have a deal with the NBA. They're supposed to renew it, but they might lose it out to NBC. And that, again, kind of puts their TV network business in peril.
Yeah, that could be a flesh wound. Geeta, we'll track that story. Geeta Raghunathan there. Some sector price action for you before we go. Abby is with me side by side.
Yes, in fact, let's take a look at the sectors. We have the S&P 500 up slightly right now, up about 0.1%, but it is a broad-based gain, as small as it may be. Now, to the downside, on the other hand, we have some laggards, tech, but down just 0.2%. And the other three sectors that are lower also by very small amounts. To the upside, we have real estate, energy, healthcare, consumer staples. That real estate really doing quite well, up 1.5% on the morning. This as yields are a bit mixed, so it gives a little bit of a reprieve to those dividends. Now, let's take a look at another dividend-rich sector. That is the utility sector. Right now on pace for a 7th up day in a row, the longest winning streak just since April 25th, and that's because this stock or this sector over the last 4 weeks higher. This is the first 4-week winning streak for the utilities index, Manis, going all the way back to 2022. Now, some see this as a defensive move because it is a defensive sector, especially given the fact that you have it rising as yields are rising. That is an interesting message. Typically, these stocks would not do better as yields rise because those dividends look less well. So again, some are saying that this is maybe some sort of a defensive shot across the bow of some weakness ahead. But on the week, I believe we have the S&P 500 higher. So an interesting mixed message there.
Abby, thank you very much. Coming up the show, we'll set your watch for you, your trading diary. Up next on Bloomberg. Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Jobless claims pop a little bit higher. Was it an anomaly or something more malevolent? Either way, yields drop. We're off the lows of the day. Stocks are struggling. Narratives from companies like Airbnb. Is that really about saturation? Right now, NASDAQ down by 0.2%. So we're treading water. We've got a pretty sizable auction coming through on the 30-year government bonds. We've got $25 billion worth of government bonds coming through. This is how the rest of your week looks like. San Francisco, Fed's head Mary Daly led it today, plus more bond sales, as I say, this afternoon. Rolling through to the University of Michigan Consumer Sentiment. That is tomorrow. Fed speak from Bowman, Goolsbee and Barr. And finally, the monthly U.S. federal budget. That was countdown to the open. The rest of the team will take you through your trading day. From New York, a very good morning.
In global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
All right, we are 30 minutes into the U.S. trading day on this Thursday, May 9th. Here are the top stories we're following. Is Apple a value stock? Flat revenues, flat EPS, and a monster buyback suggests that it might be. We'll discuss with Interactive Brokers chief strategist Steve Sosnick. And Duolingo's high bar sends shares tumbling after the app's daily active user growth cools by the most since 2022. CEO Luis von Ahn, he says that a slowdown was expected. He joins me in an exclusive interview in just a bit. And a consumer check. Shares of Edgewell, which makes big brands like Banana Boat and Schick razors, they're on the rise after the company boosts its earnings outlook. CEO Rod Little joins to discuss the state of spending. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets right now, and it's another quiet day on the screen behind me. You can see the S&P 500 we're going to call that unchanged. You take a look at the NASDAQ 100, a little bit more action, but to the downside, currently off by about 0.2%. And I also put the VIX on there. I'm not sure why. It never does much, but a quick check shows that it's slightly on the rise. We're trading with a 13 handle there on the VIX. But let's find some excitement, and maybe we'll do that with less than blockbuster results for Warner Brothers Discovery. The company reporting sales and profit that fell short of expectations, driven by low TV ad sales and poor performance at its movie studios. Geetha Ranganathan of Bloomberg Intelligence joins me now. And it's interesting, actually, you've seen a bit of a reversal in shares. They're actually a bit higher this morning. I mean, boil it all down for me. What was your takeaway from these earnings?
Yes, thanks, Katie. So again, TV advertising, the TV network business itself continues to be under tremendous pressure. We saw TV advertising falling by something like 11%, and that actually crimped EBITDA. So EBITDA was down about 19%. But there were some bright spots. I mean, free cash flow was strong. The company, which has been really executing well in terms of its merger, I mean, this is a merger between Warner Brothers and Discovery. They've been extracting synergies. They basically guided to an extra $1 billion on top of the $4 billion that they've already achieved. And then there's streaming business. Remember, this is the HBO Max business. They're seeing some good subscriber momentum there. They have a whole bunch of new international launches that are upcoming, and it's actually becoming a profitable business for them. The longer term story, though, Katie, is that the streaming business, unfortunately, will not be necessarily able to replace the linear business, and I think that's what all of these media companies, including Warner Brothers, is grappling with.
And of course, the other announcement was that Disney and Warner Brothers announced that Disney Plus, Hulu, and Max will be available in a bundle. You take a look at the reaction on social media, and everyone's asking the question, is cable coming back? What does that mean?
Yeah, I think, you had obviously the big cable bundle, then you had the unbundling, and then now you have, kind of the rebundling. And I think this kind of just speaks to how great the TV bundle was, because there was something for everybody. Of course, you paid a lot more than you actually watched, but it worked for everybody because the profit numbers, the unit economics, the math worked. And I think that's exactly what both Disney and Warner Brothers are trying to do here. They're trying to obviously go for this 4-quadrant approach. You have two of the best studios in Hollywood. All of those movies are going to come on these services. It's going to appeal to a really broad audience, and it's a great way for both those subscribers not only to reinvigorate their streaming subscriber growth, but also to curb churn. Cancellations is a huge problem in streaming, and this is really a great way for them to limit that.
Well, as we learned on 30 Rock, of course, technology is cyclical. Geetha Ranganathan of Bloomberg Intelligence, thank you so much. And let's turn to these broader markets right now, because I have a great guest sitting to my left. His name is Steve Sosnick. He is the Chief Strategist with Interactive Brokers. Great to see you in person.
Great to see you, Katie. How are you?
Let's talk about Apple. That's how I am. I want to talk about whether or not Apple is a value stock. I believe I was in conversation with Nancy Tengler last week, who said that you don't buy Apple for growth. You buy it for its cash flows, and that kind of blew my mind. What's your take?
I've been at this since November. To me, a growth stock, one of the hallmarks is that it grows, and really the revenues on a sequential basis and the profits in Apple have been flat to downish, depending on how you measure it. Now, Apple is a great company. I don't disagree with Nancy Tengler's argument. I think we're saying the same thing. Apple spins off tons of cash, and I think what their most recent announcement said is we're going to start returning it to shareholders because there's just not that much we can do with it in terms of investing it in the productive manner that we could or should. And so why not return it to the shareholders? But that's going to cause a rethink, because I think people still think of Apple as a big growth stock. It's a value stock. It's a great value stock, but it's a value stock.
So what does that rethink look like in terms of how you should be thinking about Apple in your portfolio, for example?
Well, first of all, I think it's never a bad time to add dividend-paying stocks. Apple's still really a low dividend payer, but in terms of, I think that's inevitable that dividend is going to grow. I think what happens is you have to rethink, though, are you paying a little too much in terms of PE, or are you paying a little too high of a valuation for the premier value stock vis-a-vis one of the premier growth stocks. I think Apple's not particularly expensive by that metric, but it's also not cheap by that metric.
If Apple repriced to trade at a PE more like a value stock, I think that would take down the entire market.
Yeah, but it shouldn't, because Apple is not your typical value stock. Its cash flows are so tremendous. It does deserve a premium valuation from a value point of view, which is why I sort of say we're about where we should be. But you're right, if the market revalues it, that would be very problematic.
So we'll see if that ever happens. But I want your help working through something I've been thinking about with the Magnificent Seven, of course, that grouping. I was having a conversation with my team earlier this morning. If you take a look at the Magnificent Seven, I mean, you actually have a lot of dispersions there. You have, of course, the likes of Tesla down 30%. You have the likes of Amazon up, over 20%. This is all year to date. I mean, it feels like if you invested in the Magnificent Seven, in some ways, you would actually be a little bit diversified there.
Well, diversified in terms of returns, it's sort of the Magnificent 3.5, if you want to sort of break it down that way. But the problem is you're still sort of treading the same turf. You have they are all tech stocks, although they're in slightly different niches, obviously. And some burn cash like Tesla, and some spew it like Apple, and everything in between. But to me, it's still, there's a very heavy AI emphasis in this, because you still have NVIDIA, Alphabet, and Microsoft, along with all the others having some AI. And so you're treading still the same turf. It's just interesting how the market is starting to really differentiate between these companies and their returns.
Well, I'm glad you brought up AI, because I was going to say the thing that they're burning cash on by large is AI. And I mean, when you look at the outlook for AI spends, what does the future look like?
The problem I have is I think Meta's Meta's conference call was a sea change, because I construe that as Zuckerberg saying the quiet part out loud. And this was that his comment was, we're spending billions on AI, and it could take years for that investment to pay off. Well, at some point, that means you can't just keep spending. You have to just invest, work on what you have there, not just throw money at the problem. And the example I sort of give here is the internet. We're not at bubblicious sort of territory that we were then, but the internet was this great big future prospect, and it turned out to be everything that everybody hoped for, and then some. But it took several years for those investments in internet to actually make sense for a lot of companies. And so if it's taking Meta however many years for that to filter down to their bottom line, and Meta is probably among the best companies at position to use AI, what does that mean for these other companies and the amount of money that they're spending on it? I do think that bodes a little poorly for the AI spend in the immediate term.
Well, bringing it back to Apple, really the narrative that's developed around Apple is that it's behind when it comes to AI and developing AI. I know that they announced some new iPads this week. The ads were kind of made fun of on social media. But, I mean, do you think that that's a fair characterization, that Apple is behind when it comes to AI?
I'm not so sure. I mean, I use Siri all the time, and she's AI.
That's true.
Right? I mean, so, I think in terms of generative AI, they're not getting that sort of buzz. But I think Apple, I don't like to bet against them and their prospects, because they really do know what they're doing. I don't think they're the sexy version of AI, though. But it is important to remember that some version of artificial intelligence has been around for decades. I studied AI when I was in college, and that unfortunately dates the practice several decades. But that's kind of the point. This is the latest and greatest version of AI that is the most user-friendly version of AI. Apple may be behind the scenes in terms of the vanguard, but we literally carry and speak to this AI device in our pockets all the time.
It's a great reminder that, of course, AI, it's been around for longer than 18 months. Unfortunately, we have to leave it there. Steve, it's always great to see you. Really appreciate your time. Our thanks to Steve Sosnick of Interactive Brokers. Let's take a look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Denitsa Seikova, and on the move in a big way, we have Airbnb.
Yeah, Airbnb is feeling a lot of pressure today. This, of course, comes after a second quarterly weak guidance. That said, the earnings report was good, but it didn't bring enough relief for investors. Investors have been really focused on those travel companies. We saw what happened with Expedia. We saw what happened with Booking. Worse than expected guidance, disappointing results. So definitely there is a lot of turmoil in the travel industry. Of course, there has been a really good year post-pandemic, but the market has been very choppy. There has been a lot of volatility. So that potential outlook and decreasing travel spending right before the peak summer season is an issue. That said, Airbnb is optimistic about international payments and like Asia and Latin America. So maybe that can give a boost to the company in the future.
Yeah, it remains to be seen, but it's a good point. When it comes to some of the expectations that these companies were up against, a lot of them haven't been able to quite clear that bar. So that's the Airbnb story. Tell me about Bumble.
Yeah, so we have some good news in the online dating apps. So the earnings report was quite good, which is in big contrast to what we saw from Match recently. The stock is seeing really big support today, but of course that is much needed relief for a stock that was down more than 30% this year. Company swung to positive earnings to 33 million, up from a loss of 2 million in the previous quarter. JP Morgan analysts are actually quite optimistic, and that is because comparing to Match Group, which had a pretty bad earnings report and a decrease in users for quite some time, they say Bumble looks quite attractive. And another positive thing for investors is actually that the company increased its buyback program. So that can potentially be more good news for investors who have seen a lot of struggle this year in Bumble.
Yeah, that definitely sweetens the deal a bit there. You can see Bumble shares up about 6%. And bring it home, just quickly tell me what's going on with Robinhood, because it feels like they put up a beat and then some.
Yes, Robinhood is doing great today. The earnings report was second straight quarterly profit. Everyone is talking about the crypto number. Revenue from cryptocurrency surged 232%. Everyone has been talking about retail resurgence. We're seeing it. Of course, there is some pressure from the SEC about how they classify crypto assets. So we're about to see whether that can put more pressure downwards to the stock.
All right, Bloomberg's Anitza Seikova, really appreciate your time and that roundup. Now, coming up, bad news for the bilinguals. Language app Duolingo, it sees slower user growth. We're going to be speaking to Luis von Ahn, the company's CEO, next in an exclusive interview. This is Bloomberg.
This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Well, shares of the language learning app Duolingo, they're falling by a record 19% right now. That's after it revealed slower user growth in its latest quarterly report. I'm pleased to say that we're joined now by the company's CEO, Luis Von Ahn, in an exclusive interview. And it's funny, I mean, you actually read through the details. You beat on daily active user growth. You beat on EPS. You also raised your revenue outlook for the year, but it feels like really you're a victim of your own success here in terms of the market's expectations for you.
Yeah, I mean, we had, the market's going to do what the market's going to do. We had 10 straight quarters of accelerating user growth. In the last quarter, it was about 64% year-over-year daily active user growth. It went down a little bit, but it's impossible to have accelerating user growth forever. But we're more focused in the long term. I mean, next quarter, for example, we think is going to be a little bit better than this quarter. So we're focused on the long term, and we see a huge opportunity ahead of us.
So let's talk about the actual numbers here. So daily active users rose 55%. That is more than double what it was 18 months ago. Like you said, you can't have, crazy growth forever in perpetuity. I'm sure a lot of people would like to. What do you see as a more normal, reliable range going forward, though?
I mean, we expect that at least for the rest of the year, we're going to be somewhere between 50 and 60% year-over-year growth. And it's just because there's a lot of, we're just getting started. There's about 2 billion people in the world learning a foreign language. We're the largest language learning, method in the world, but we still only have about 100 million monthly active users. So there's still a lot of room to grow. We're also very concentrated on teaching English better. There's something strange about the English learning market and Duolingo. If you look at just language learning as a whole, the overwhelming majority of people are learning English, but our users, less than 50% of them are learning English. So there's a huge opportunity for that, and we're very concentrated on that.
Well, that was a big focus in the earnings call as well, that strategic focus on the English product. So tell me a little bit about where you are there. Of course, like you mentioned, less than 50% of your users are learning English. I mean, where are you in terms of developing and really attracting those users to the English product?
Yeah, English is a very different language than every other language to learn. Usually other languages are learned as a hobby, and most people who come in to learn a language come in with little to no knowledge. English is different. English is usually learned to further your economic possibilities. And most people who come in come with prior proficiency, and they want more advanced levels of the language. So this is what we've been developing, much more advanced levels for English in particular. Over the last year, we have now launched, it's very recent, but we've been working on it over the last year, but we have now launched for all of our English courses, intermediate to advanced content. So the content is now there, and now we're working on getting the word out that Duolingo is good for advanced English learners. So we expect that to have a pretty big impact over the next couple of years.
And how do you get the word out? Because I know that Duolingo is pretty popular on social media. I mean, I see the big green bird on TikTok all the time. I mean, tell me a little bit about your marketing campaigns.
Yeah, our marketing is unhinged. I mean, we call it wholesome unhinged. We're very popular on all social media, not just TikTok. It's Instagram, YouTube, and it's organic. And we pay very little for marketing. Generally, it's just all organic posts, and it's usually. We're just very good at doing things that people actually want to see. Our owl mascot, those kind of crazy antics. The good news is that we're able to also put our message out, and we're really trying to do that, especially for English learners, to show that we are efficacious for more advanced people.
And like you said, I mean, when it comes to marketing, you have that owl out across platforms. I see it the most on TikTok. I unfortunately spend a lot of time there. And I have to ask, I mean, if there's a TikTok ban in the US, what would that mean for you?
Yeah, we've obviously been looking into that. When we got big on social media over the last few years, TikTok was the first platform that we got really big on. But we've realized that this is, that there's some risk of TikTok, particularly in the United States. So we've been diversifying. By now, actually, YouTube is larger for us than TikTok. And also, TikTok in the US accounts for the minority of the views compared to international. So we have many more views on TikTok internationally, and we have more users coming in from YouTube. So our sense is that, this is, if TikTok were banned in the US, it wouldn't be that impactful for us, particularly because our belief is that most users, if TikTok were banned, would go to pretty similar products, and YouTube has YouTube Shorts and Instagram has Reels. So probably what would happen in the US if TikTok were banned is that users would just go to these two platforms where we're already pretty big. So we're not particularly worried.
It would probably be good for me. I mean, personally, I would probably be a lot more productive. But point taken there. I do want to talk about your different subscription tiers, because you have free Duolingo, you have Super Duolingo, now you have a third tier called Duolingo Max. I understand that you just started really rolling that out more broadly in April. And just to set the scene here, I mean, what is the difference between Super and Max?
Sure. So we have three tiers. For context, the free tier, it's about 91% of our monthly active users are in the free tier. We monetize them through ads. And then, to be precise, 8.6% of them are paying subscribers. The majority of them are in our standard premium tier called Super Duolingo. That's what we've had for several years. Of late, we've started a third tier. And the reason we started a third tier is because we realized that there is appetite for some users to have something even more premium. So we have Duolingo Max. It's just being rolled out right now. Somewhere between 5 and 10% of our daily active users have access to even purchase Duolingo Max. And what it has is some features that help you practice conversation a lot more, and they use generative AI. So right now the price point is about twice as much as Super Duolingo. I don't know where it'll end. We're still testing prices. But we're seeing really good uptake on it, and so we're pretty excited by it, actually.
And I only have about 30 seconds left with you, but just tell me quickly, I mean, that continued rollout of the Max product, how much of that is baked into your 2024 forecast?
It's there. However, the contribution is in the forecast. But with the way we roll out features, usually it's over a long period of time, because we roll them out, on different languages and on different markets. So the contribution is there, but it's not going to be huge for this year.
All right. Really enjoyed this conversation on what I'm sure is a busy morning for you. Come back soon. Our thanks, of course, to Luis van Ahn. He is the CEO of Duolingo. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
for social climbers. A look at the stocks making waves on social media this morning. And first up, Apple's new iPad Pro ad. It's drawing fire on social media. The ad, it shows a giant machine slowly crushing a palette of creative tools such as instruments, paint, and books before it reveals the new iPad. Critics say that the spot is cruel and tone deaf, noting that it's being interpreted as a metaphor for the threat imposed by AI. I actually thought it wasn't that bad, but no one asked me. Next up, we have the Cheesecake Factory bringing home the dough to investors after the restaurant chain reported earnings that beat estimates, thanks in part to its lucrative rewards program. Raymond James upgrading the stock to outperform. And finally, we have the youth-centric gaming giant Roblox reporting a weaker than expected forecast in the second quarter. Roblox recently pivoted towards e-commerce and advertising. It's a move that has raised red flags for watchdogs. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, we take a look at these markets right now because we have a little bit of a reversal underway. You take a look at the S&P 500. It's higher by about 0.2%. Remember, it was unchanged about, 26 minutes ago. So again, a small reversal, but a reversal nonetheless. Also, the NASDAQ 100 still lower, but slightly less, currently down about 0.1%. Now coming up, the name behind some of your favorite brands, such as Banana Boat, it's boosting its outlook. We're going to speak to Rod Little. He is Edgewell Personal Care President and CEO next. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Edgewell Personal Care brands boosting its earnings outlook for the full year. Edgewell, of course, the company behind brands such as Hawaiian Tropic and Banana Boat. For more on these earnings, we're joined now by Bloomberg's Abigail Doolittle.
Makes me want to be on a beach for sure, Katie, and see some sunshine, ocean, and sand. But as for the quarter that was, it was a very good quarter. They beat, and to your point, they also boosted the full year. They beat on both net sales and adjusted earnings by a solid amount. They maintained the quarterly dividend at 15 cents per share. Now, relative to the boosting of the guide, some are saying that it's at toward the lower end of the range, but nonetheless, a boost is a boost. Let's take a closer look at revenues, put it into perspective of where revenues have been. So nearly $600 million in revenues in the second quarter. That did beat, was above sequentially the first quarter, the fourth quarter, about even to the second quarter on a year-over-year basis. Not surprisingly, with these solid results, the shares of Edgewell Personal are higher on the year, as is the case with a lot of the other personal care companies. You can see Edgewell on the year up 6.5%, Kimberly-Clark, Procter & Gamble, and then Nu Skin, a very limited market there. That is the odd stock out down, my gosh, 35%. But take a look at Edgewell Personal Care, up 6% year-to-date so far, Katie.
All right, Bloomberg's Abigail Doolittle, thank you so much for that setup. And for more, let's keep the conversation going with Rod Little. He is Edgewell Personal Care President and CEO, joining me now. It's great to have you back with us. The last time we spoke in February, we spoke a lot about international strength relative to the U.S. When you take a look at those markets right now, has the U.S. come back, or is international still leading the way?
Good morning, Katie. We're still seeing the trends continue that we talked about last time. International markets continue to grow well for us in our categories. Internationally, our business is primarily shave and some sun care business. And what we're seeing is growth in the shaving market, category-wise, internationally. And as you saw travel internationally really reopen last year and projected to be higher again this year, our sun care business benefits from that as well with our brands Banana Boat and Hawaiian Tropic. Domestically here in the U.S., in our categories, if you take an aggregate index and average the categories we participate in, so shave, grooming, sun care, skin care, and feminine care, those categories on a past 52-week basis grew about 5%. In the quarter ago, grew 2%. In the quarter just finished, almost flat at 0.4%. So still growing, but we're seeing a slowing of the growth rate domestically here in the States in our categories.
And why do you think that is? I mean, is that just the bounce back of travel, sort of, that impulse still coming back? Or does that say something about the U.S.?
I think it's something about the U.S., specific to the U.S., around what we're seeing is a bit of a shift in consumer habits towards spending on occasions and services. I've been reading about that. We're actually seeing that. And I think as consumers are challenged with inflation, things are expensive right in the basket. And you look for ways that you can maybe reduce your spend in some areas to pay for things that have gone up in price. Our area, when you look at our categories, we've not taken a lot of price against our brands. We've taken what I think is a minimal to moderate level of price, but yet the whole basket is still more expensive. And so I think you see consumers looking to maybe use a product a little longer, a shave cartridge, for example, maybe get one or two more shaves out of it, extend that purchase, and also looking to potentially trade down in price from a more expensive razor to one that's more value-oriented. We have the Billy brand, as you know, in women's shave, an amazing brand. It's now up to a 10 share domestically, 17 share at Walmart. That wasn't even in the market 2 years ago, and that's in a value price point. And so I think it's a combination of all of those things. And then also what's impacting us specifically is in the early start of the season here in sun care domestically in the U.S., the bulk of that business sells through the southern half of the United States. And it was very wet and rainy early in Florida. And so the whole sun care category was down in the first quarter of the year.
Yeah, my parents are in Florida, and I heard a lot about that. But to that point, something I was wondering is, when it comes to your business, how seasonal is it? Obviously, we're approaching summer up here in New York, and I'm wearing a lot more sunscreen. But do you see those trends in your business?
We certainly do in our business. Our two brands, Banana Boat, Hawaiian Tropic, are occasion-based brands. And so what I mean by that is when people go outside, play a round of golf, go to the park, go on a hike, go to the beach, go to a pool, that's when our brands traditionally get used. You probably don't think of our brand for an everyday SPF experience. We're looking to build out our business in that everyday SPF range, whether we do that organically with our own brands or some new brands or acquire some brands. There's definitely room in our portfolio to have that everyday SPF part come into our lineup. But in our brands that are more occasion-based, it definitely revolves around temperature and sunshine, drive sales. So the bulk of our business in sun care domestically in the U.S. sells in our quarter two, which is calendar quarter one, and our quarter three, which is calendar quarter two. And so you get the early sell-in to retailers. As that sells through, you then get replenishment as you get into the summer. So very much a seasonal business domestically.
A seasonal business, and it sounds like there's potentially some M&A in your future, so we'll keep an eye on that. But let's talk a little bit more about retailers, because of course you're in stores like CVS, like Walgreens, like Rite Aid, which of course declared bankruptcy in October 2023. What has the impact been on your business from that?
Yeah, we've been impacted by the drug channel struggle, if you will, more broadly. We are overdeveloped in the drug channel. Our brands have some of our highest shares in that channel versus some of the other channels. Part of that is historically, it's been one of our strongest areas of our sales team and our capability and our ability to be responsive to the drug channel and their needs. And so as the channel has suffered and seen foot traffic down double digits in some cases, we're not immune to that. And so we've been impacted by that. And on Rite Aid specifically, that was a customer that on an annual basis is over a point of growth for us at a total company level. Wow. That we've had to take to zero from a shipment basis. Now, over time, you would expect consumers to go to other stores to pick that back up. But in the moment when you take the sales out, it goes from a sale to a zero. And so that's what we had happen to us last quarter with Rite Aid.
Have to imagine that's painful. And it's a good point that it takes a little bit for new habits to form. But something I was wondering about when it comes to drugstores such as CVS, such as Walgreens, I mean, at least in New York City and other cities, you can't walk into a CVS without seeing everything basically behind plexiglass. And I'm wondering, have you seen any impact from shoplifting on your business?
We have, and it's not a new phenomenon. Razor blades, for whatever reason, I guess it's just price point, and they're small, have been something that people have targeted for theft for a long time. And so well before the pandemic, we had examples of razor blades being locked in cases where you have to ask a store employee to help you get the blades. That happens outside the U.S. as well in some markets, but definitely we're seeing the proportionality of that increase. And you're now seeing that move beyond just drug channel into some of the mass channels, with some of the big mass players having to do that as well, primarily in some of the larger market metro areas.
And it's probably a good point to leave it on. Shoplifting, nothing new, but of course, definitely in focus in recent years. Rod, really enjoyed this conversation as always. Our thanks to Rod Little, the CEO of Edgewell Personal Care. Let's get a check on these markets right now. We're going to do that with Bloomberg's Abigail Doolittle.
We're looking at a little bit of a gain for the S&P 500, Katie. And importantly, according to some of the market strategists and watchers out there, the S&P 500 back above right now at least 5,200. Now, this is a weekly chart, or so far the week for the S&P 500. And you can see in this range, but right now breaking above 5,200. This is very important resistance. If the index can close above 5,200 today, and then more importantly on the weekly basis, it may suggest that there's a new leg higher for the bulls. If not, back into the range, and then this small range, and then there's a bigger range that we were talking about yesterday. So there still remains a little bit, or I would even say a fair amount of uncertainty between the bulls and the bears in terms of what's going on relative to earnings, and of course the Fed and all the data that the Fed is watching. Now, for positioning on the S&P 500, what we're looking at here in green is the S&P 500, in white the CFTC positioning, and you can see up and away out of those 2022 lows, October, but there have been retreats from periods of time. So right now, we do happen to be in one of those retreats. The question is, are we going to see more of a retreat? If that's the case, it probably is less likely that we'll see the S&P 500 go, or stay, I should say, above 5,200. But if we see this level, this positioning go back higher, then maybe that will be a good sign for the bulls. As for some of the stocks moving on today, we have lots of earnings movers, including AppLovin, up 18%, a really big move for the end-to-end software company. They put up record sales and just a really good quarter and guide there. Robinhood also higher, up about 0.3% at this point. It had been much higher earlier and certainly in the after hours yesterday on 232% crypto growth, among other metrics that beat. Airbnb to the downside, though, down 6.2%. This, of course, after they gave another tepid quarter of guidance. The revenge travel out of the pandemic, Katie, appears to be coming to somewhat of an end, at least for Airbnb. And then ARM Holdings, the chip company, off of its lows, down 1.8%. They beat, they boosted, but the boost really not a little bit lackluster. And of course, this is one of the few companies that has actual AI revenue. Perhaps investors looking for more of an AI boost. That stock right now down 1.9%. Not so bad, though, Katie, when you consider that into this quarter up more than 40%. Price to perfection. So it could be certainly down much more.
Yeah, definitely. Context matters there. But overall, really tough crowd this earnings season. Bloomberg's Abigail Doolittle, thank you so much. Coming up, former House Speaker Paul Ryan joins Wall Street Week to talk about the challenges of a divided government and its impact on the 2024 presidential election. This is Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these mean things.
Yes, we do. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg, context changes everything.
it's time now for our daily Wall Street Week conversation. Wall Street Week host David Weston, he spoke with former House Speaker Paul Ryan at the Milken Institute Global Conference in Los Angeles about the challenges the next president might face.
Number one would be tax policy. What's the tax code going to look like? What's tax policy looking like in the future? Number two, I'd say tariffs. So number three, I think it's reasonable to assume the next president is quite possibly going to face a debt crisis. You don't know when that is or exactly what form that takes place, but a lot of fiscal policies on the line, tax policy, trade policy, debt policy, therefore interest rates.
So let's take those in order. Taxes. How much of that depends on what happens in the House and the Senate, in addition to what happens to the president?
I think it's reasonable to expect we're going to have divided government. I feel so good as a Republican that we're going to take the Senate just because the map is so good for us. The House, I mean, it's basically a tied House right now, so that's kind of a coin toss. Probably depends on who's going to win the presidency. But my guess is it's most reasonable to assume divided government. That means Biden or Trump won't run the table. And when the 2015, with the law that I worked on quite a bit, the Tax Cuts and Jobs Act, a lot of that stuff expires in 2025. Not the corporate side, not the corporate rate, not the territorial system, the individual side. If Republicans are in more control, that means we extend Tax Cuts and Jobs Act. If Democrats are more in control, they're going to do everything they can to let most of it expire. The problem, if Biden gets what he's saying he wants, and look, I'm not a Trump supporter, but I'm also not a Biden supporter. I'm one of those in-between people. He's basically saying get rid of Section 199A. That means all those small businesses, those pass-throughs, have a big tax increase. You know, I'm talking about LLCs and subchapter S companies. Expensing's already gone away. That needs to be put back together. That could happen. But the top rates and maybe all the income tax rates could go up. At the very least, you'll probably see a fiscal cliff kind of a deal like was done with Obama, where the top rate probably goes back up to 39.6 from 37. I could see a bargain like that between divided government, but I have a hard time believing even a Biden administration is going to let all the income tax rates go up. If they get their way and if they have all of Congress, they're proposing that. He's actually proposing about a 44.6% capital gains tax. You add state on top of that, you're at 50%. That's economic nihilism. So what Biden's running on and what he could actually do in office are two different things, I hope. But if he does get a sweep, then it's going to be awful. But if it's divided government like I think it's going to be, it's probably going to be a split the difference. Maybe the top rate goes up, individual rates, the rest stay the same. Hopefully get full expensing back in place. And that Section 199A, which was really important for those medium and small-sized businesses, hopefully that gets extended.
As you say, you worked hard on the Tax Cuts and Jobs Act. Before that, you were a student of the economy and the relation to government. What is the delta on economic growth, depending on whether those tax cuts get extended or not?
Well, I'm sure there's some good analysis, but I'd say you can near a half a point to a point. But more importantly, it's the future. It's productivity. It's wage increases. When we did the Tax Cuts and Jobs Act, we had great growth in wage increases, real wage growth ahead of inflation, clearly, especially for the bottom two quintiles. So, you know, we're living on borrowed time where we're not increasing productivity, and a lot of those tax cuts are productive tax cuts, meaning they help productivity, plant investments. That gets you higher living standards. That gets you faster wage growth, and you'll start draining that if you don't extend those things. So over the long term, the effects on growth are going to be much larger than over the short term, but over the long term, they're going to have tremendous impact. And don't forget, we're in a global economy. If we're sending most of our businesses are pass-throughs, which most people don't know. They're not C corporations. And if we're going to tell these pass-throughs, your tax rate's going to be up around 40%, and you're competing in this global economy, that's really ugly economics. That's anti-competitive. That's what they'll do if they let Section 199A go away.
So the second thing you mentioned was tariffs, at stake in this election. I was a little surprised at that, because actually President Biden hasn't really dialed back, for example, the trade tariff very much.
I don't know who's going to be the president, but Trump's promising a 10% tariff across the board, which is a giant tax increase on American consumers. Everybody's going to fight China. A Biden presidency is going to fight China. A Trump presidency is going to fight China. The question is, what about the other countries? The frustration for me is neither of these two presidents want to do trade agreements. We should have done TPP, in my opinion. It's a very good China policy. But neither Trump or Biden are proposing any trade agreements Trump's proposing across-the-board tariffs. Biden's not proposing that, but he's not also proposing to get new agreements to get new markets for our products, our goods and services. And if you're standing still on trade, you're falling behind because all the other countries are going around the world getting their own preferential multilateral and bilateral trade agreements, leaving us on the outside looking in. So you can't just stand still on trade, but unfortunately that's what we're doing, and that's what, frankly, both these guys are proposing to do.
And that was former U.S. Speaker of the House Paul Ryan and Wall Street Week host David Weston. And tomorrow we'll hear from Jenny Johnson, the president and CEO of Franklin Templeton. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Well, it hasn't exactly been a healthy year for Moderna. In fact, it's the worst performing large biotech in the U.S. as investors really question the company's pivot to RSV vaccines. Joining us now with more is Bloomberg's Jerry Smith, who wrote a great piece on this. So, of course, we know Moderna because of COVID. They're pivoting hard, putting a lot of eggs behind, of course, RSV, but they face some stiff competition.
Yeah, that's right. I mean, their next product that's not COVID is their RSV vaccine, and it's expected to get FDA approval this month, and it's going to be challenging for them. Analysts are expecting that they'll, be in third place behind GSK and Pfizer, who already have RSV vaccines on the market and have a year head start, and also have a lot of experience with, selling vaccines to big pharmacy chains, which is where a lot of the RSV market is, and that's something Moderna hasn't really had much experience doing. During the pandemic, the U.S. government bought their COVID vaccine in bulk, and now they have to learn how to actually go out and sell their shot.
Yeah, some boots on the ground there to sell that shot. So, of course, they have COVID, sales obviously going down. They have RSV, maybe they're going to be in third place there. What else do they have in the pipeline?
They have a very big pipeline. I mean, they're working on more than 40 drugs, and they're all relying on this mRNA technology that they really believe in. One of their most ambitious parts of their pipeline is cancer treatments, and so they've had promising data on a melanoma vaccine. That's their most advanced cancer treatment, but they're looking at other tumors, and analysts say that could be a lucrative opportunity for them if it works out.
If it works out, that feels like a big if. And in terms of, okay, we have promising data, but in terms of actually getting a product to the market, I mean, how far away would something like that be?
Yeah, I mean, Moderna, there's some steps they have to take with their melanoma vaccine. They say they want to apply for accelerated approval, but there's some steps they have to do, like completing a new manufacturing facility in the suburbs of Boston. So, it's not imminent, but it's something that, their investors are certainly watching very closely the progress with their cancer programs.
And just in about 30 seconds, I mean, I feel like Moderna, reading through your story, comes under some fire for spending a lot of money, but I feel like a drug company has to spend a lot of money on development.
Yeah, I mean, they are spending, over $4 billion on research and development. And, from Moderna's perspective, they believe in mRNA technology. Their CEO calls it a platform, and they feel like, hey, it worked in COVID it should work in all these other diseases. And so they are spending heavily on R&D. And, now the question is, can the revenue, help support that?
All right, time will certainly tell. Bloomberg's Jerry Smith, thank you so much. And let's quickly take a look at some stocks hitting highs right now, because Amazon hitting a new 52-week high. The company announcing it will launch a new online store in Ireland in 2025. It will offer products with local prices that don't include custom charges. You also have Barclays hitting highs, with the CEO saying that the firm's recent stock rally is evidence that investors support the UK bank's strategy to double down on its home market. And we do have a programming note. Check out Bloomberg Space. It'll cover investments beyond Earth. It is the latest editorial offering from our newsroom. That's Bloomberg.com/space. And coming up, the Bloomberg Technology Summit in San Francisco is next, but that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made, and they won't watch things. And I think part of the misalignment I talked about before is, imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range, because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that, I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
This is Bloomberg.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from sunny San Francisco, I'm Caroline Hyde.
And I'm Ed Ludlow. This is a special edition of Bloomberg Technology. Coming up, we'll bring you live coverage from our technology event as we speak with the CEOs and visionaries that are driving change in Silicon Valley and beyond.
Now, Ed, this hour we're speaking with the CEOs of Arm, of Hugging Face, of Writer AI, and more as part of our live special.
And a lot more to come. We'll push ahead to our keynote speakers later today. That includes Adam Newman, Whitney Wolfhard, Evan Spiegel, and more. And while it may not be a surprise to anyone tuned in, it's certainly not a surprise to us. Artificial intelligence is probably the overriding theme of the event. It's AI everything, even in some cases if you're not an AI company.
Yeah, I mean, I think it has to be, even if you're not the AI company at heart, you're thinking about how you adapt to it, push it forward, bring out the productivity. But ultimately, how do we live up to the hype? Yeah. The valuations are so extraordinary in the private markets. They've been pretty heady in the public markets as well. Are we really seeing the level of productivity and growth and real use cases to vindicate it?
These events are always very interesting, very engaging. Everyone's very positive. But I would say in the background, there's a talent war, frankly, and people are running out of cash. So we've got to ask those difficult questions too.
And geopolitics. How are you navigating the issue of China as well? So much to talk about. But in the here and the now, we're talking about one key infrastructure play when it comes to artificial intelligence. We're, of course, going to be talking about the chip design firm Arm, which has really bounced off of its lows in terms of its share price throughout the trading of today. We're currently over the last 2 days down by 1.3%, coming out after the bell with its earnings. Tepid forecast, Ed, was what the market seemed to be focusing in on, even though they absolutely smashed it in terms of their fiscal fourth quarter numbers and their first quarter look ahead. Let's dig into some of that caution with Renee Haas, who's the Arm CEO. Renee, wonderful to have time with you. And look, there does seem to be a worry about your full year forecasts. Are you being cautious?
Well, thanks both for having me, Ed and Caroline. We just came off a record year in terms of revenue. We were up 20%, a little bit over 20%, our fiscal 23 from 2022. And we're actually forecasting even higher growth this year, north of 20%. And we also signaled to the markets yesterday that in 25, 26, 27, we see that growth continuing. So we have incredible visibility to our business, and we're very, very confident of this growth rate going forward.
We're just seeing your shares actually tick into positive territory, Renee, up now 0.6%. The underlying story is the build out in AI infrastructure, right? We're talking about data center powered by GPUs. Your numbers were good. Tell me about the underlying demand then, about the long term and the addressable market you think is either intact or is not.
Well, I think this AI build out, as you describe, or maybe said another way, just expanding capacity to run these foundation models, to do more and more training, to do more and more inference. We really are only at the very beginning, because when you start to think about the capabilities that this could unleash, whether it's around healthcare, pharma research, productivity gains, call centers, we're still in the very, very early days. That all starts with having to do this level of training and inference in the cloud, but it ultimately will find itself into every single edge device, whether that's a PC, your smartphone, your car, and whether it's all those devices I mentioned, from the data center to the edge devices, they all run on ARM. So we have incredible visibility to where this is all going, which is why we're very confident in the growth rates. They're also one of the big problems you've got with all of these AI data centers is around energy and power. So power efficiency being so key, it's what ARM is really good at. Increasingly, we're seeing the most complex applications moving to ARM, and the most sophisticated training chip on the planet that was just announced, Grace Blackwell, well, that's based on ARM.
Okay, so you're managing to really think that you're going to be the server play as well as the PC play, the cell phone play. And I want to focus in on the cell phone play, Renee, because that's been where your bread and butter has been in history. How are we looking from a smartphone perspective? Is the market looking strong to you? We've had many a mixed message coming from China demand, for example.
Overall, what we've seen in the smartphone market, particularly for ARM, has been quite a good growth rate in terms of royalties. Our version 9, which is now being used in many of the premium mobile phones, that drives a higher royalty rate for ARM. There's also more complex CPUs that go into that. That's also better for ARM. And going forward, Caroline, one of the things that we're seeing, and it's not just in smartphones, is that as these AI models are moving so fast, the hardware can't keep up with the software. The software innovation is happening so quickly that by the time the hardware is ready to run those models, everyone wishes they had more performance, they had more efficiency. So what does that mean for ARM? It's driving growth in our licensing activity. People are looking to do more and more design chips faster and faster, and that's all good for us going forward. So I think going forward, you're going to see more and more innovation happening, not only in the smartphones, but across all these edge devices.
What's interesting, Renee, is it's hard to keep up with the pace of geopolitical change as well. The latest news coming that Huawei, of course, is not going to have access to Qualcomm, to Intel chips. You are, of course, a UK-based company, but are affected by US policies. Has this impacted your business, the limitations of Huawei's access to chip design, to chip technology, to licenses?
Yeah, so that issue that you're referring to specifically was when Huawei was placed on the entity list, I think 2019, 2020, companies had to apply for a license to exempt them to ship to Huawei. So a number of companies asked for those licenses, they got those licenses, now those licenses are being revoked. We don't fall into that category in any way, shape, or form. We didn't apply for any licenses at the time to ship. We complied with the export controls as they were laid out. So there's really, it's a non-event for us in terms of what you're seeing with Qualcomm and or Intel.
We're speaking live to the ARM CEO, Renee Haas. We're on the ground here at Bloomberg Tech in San Francisco. Last week, Renee, Cristiano Amon was on the show telling Caroline and I, this is the year of the AI PC. You were asked about that on your earnings call last night, and you gave a slightly different answer. Maybe it's not the year of the AI PC, more the 12 to 36 month window, and you don't want to see just one PC supplier. You said you'd like to see 2 or 3. What's your beef with Qualcomm?
You know, when I look at the PC ecosystem, one large ecosystem has already moved to ARM in a very big way. Apple is now 100% based on ARM. All the Apple silicon is based on ARM. And you see amazingly good products relative to what they've delivered. Fantastic battery life, performance, thin and light, no fans. When you think about the Windows market, it's a very different market. It's highly fragmented. You have lots of different players. The ecosystem matters. The channel matters. Price points matter. High-end gaming machines versus low-end devices that are like cloud-enabled. So what does all that mean? It generally has meant that breadth, vendor choice, multiple options to provide a full scope is what matters. And what I'm hearing is over the next couple of years, the Windows ecosystem is going to be able to afford that. And I think over the next 2-3 years, I do believe Windows on ARM will be real. I think you'll see multiple players, multiple price points, multiple units, and I think you'll see meaningful market share that we start to gain. The kind of performance you see in the other ecosystem, I think will find its way into the Windows ecosystem.
Renee, I wanted to talk about geography really quick. We're here in San Francisco, right? There's a lot about America's R&D focus on AI-related chips. Are you seeing this sort of equivalent activity in Europe, for example, or any of your customers outside of those markets?
Yeah, well, I'm in San Francisco today, too, so I will see you a little bit later. But in general, I think the geopolitics are something that all tech CEOs are now having to figure out and work with. AI models, foundation models, sovereign clouds, thinking about what level of training takes place in a country versus outside the country, where the weights sit, et cetera. So these are all the kind of things that politicians have never really had to think about in the past. So we're involved in a lot of those conversations, Ed, whether that's in the United States, whether that's in Europe, and really just trying to understand it, because I think lawmakers in all these jurisdictions are just trying to figure it all out. And as I mentioned before, as the software and models are moving so fast, it's difficult for everyone to keep up. But we are central to all those discussions.
Renee, what's been keeping up is your valuation. Boy, I mean, do you think there's too much exuberance around AI valuations out there? Are you going to make the most of it by, well, we talked at one point of listing in the UK too?
Yeah, you know, I don't think about the valuations as much as I just think about the AI opportunity, which I frankly believe is undercalled in terms of just what it's going to mean relative to society and what it can do for our planet. I think, again, we are in very, very early days in terms of the capabilities of what this can unleash for our society. Incredibly excited to be part of it, but I don't think we're part of a hype cycle at all. I think there's a lot of innovation taking place, and you know, frankly, the innovation that's taking place and the inventions that we're seeing, it's just breathtaking. So no, I don't personally view it as a hype cycle at all.
Renee Haas, ARM CEO, really grateful. You'll actually be here with us later today on site at Bloomberg Tech. Your stock opened pretty low, and I think it's just a little bit higher now during the conversation we've had. Thank you so much. All right, coming up on the program, we're going to be joined by Clem DeLong, CEO of Hugging Face. That's coming up next. Stay tuned. We'll be right back. This is Bloomberg Technology.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? Yeah. I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier. Right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome back to this special edition of Bloomberg Technology, live in San Francisco at the Bloomberg Tech event. And artificial intelligence, surprise, surprise, is sort of the overarching theme We've got a pretty good guest to talk about that with and discuss all things large language model with Clem DeLong, CEO of Hugging Face. You made this prediction, which we're going to hold you to account on, that by the end of this calendar year, and I appreciate we're not even halfway, open source models would be equivalent to the best closed source models. Give us a status check of that prediction, please.
I think it's already happened. Open source now is better than closed source for most use cases. We've specialized, customized models on the companies like datasets. I have my Meta Ray-Ban glasses here that are powered by Llama 3, right? We're seeing so many now use cases being powered by open source models. And most of the big tech companies are now publishing open models. Just last month, we've seen Apple releasing open models on Hugging Face. We've seen NVIDIA, we've seen Snowflakes, we've seen Databricks, we've seen Microsoft. All of them now are publishing open models.
There may be some people in attendance who don't agree with him, which is why I asked the question.
Well, also, Microsoft published one and then quickly withdrew it from some of the reporting because they hadn't stress tested the large language model enough. They hadn't whittled out some of the toxicity checks in particular. How are you feeling about the way in which large language models are growing and the way in which governance is developing around it?
Well, we're starting to see that the most important question is concentration of power, right? For such an important technology, you don't want a world where just a few companies are controlling it.
But that is the world we live in.
I don't think so. I think more and more what we're seeing is that with open source, you can actually distribute power more. And you want to reduce the gap between the most powerful companies and the rest of the world. Not only other companies, but policymakers, non-profits, academia, and all of that. And that's the purpose of open source. It reduces the gap between the most powerful companies and the rest of the world. And that's what creates kind of like a sustainable, balanced future for AI and technology as a whole.
It's a conversation we're going to have all day long. And you point out that basically open source allows more groups to go to work on it. The problem is, as we're learning, the tens of billions of dollars it takes to train models with, tens or hundreds of billions of parameters, and then you go lower down. And now what we're hearing is that actually there are the folks doing this running out of cash. Are you seeing that as well?
So it's more or less true, because for example, now you can use Llama 3 that really has been costly, but that Meta has released and fine-tune it for a very small amount of money. That's why on Hugging Face, there's over 1 million models that have been trained by companies. And a lot of these companies are very small and don't have really, really big budgets. I feel like today, every single company has to build their own AI. Otherwise, they run the risk of being left behind. And that's what we're seeing. And it doesn't require any more really, really big budget. An interesting point, though, that we're going to see this year, though, is that we'll need to find for AI companies better business models. That's what kind of like you hinted at. Something we really focused on at Hugging Face. We are lucky and grateful to be close to profitable, which is very unusual for AI companies. But we're starting to see that there are some ways to generate revenue and not burn insane amounts of compute for AI startups today.
I mean, how, on that profitability perspective of yours, how many paying customers do you now have? Can you give us an update? You've got 1 million models. What about paying customers?
We have more than 10,000 paying customers. Out of the over 100,000 organizations, more than 4 million AI builders that are using our platform. And I think we found the right balance between monetizing, especially with big companies that are using the platform in private.
Enterprise companies.
Exactly, in order to fund all the free community open source work that we're doing, and that is always going to stay open source and free, of course.
I want to go back to what Ed was saying, though, about people running out of cash. You actually put out a really interesting call on X, basically saying, look, I'm here if you need me. Hugging Face is here if there are good people out there building interesting businesses, but you're running out of money, we could be a home for you.
Yeah.
Are you making acquisitions? Is it acqui-hiring that goes on then?
We make some acquisitions. We're going to have interesting announcements in the next few weeks, actually.
Oh, don't tease us. What is the interesting announcement?
But I think in general, in AI, you're going to see more and more M&A. Because as you said, I think a lot of companies took very risky bets. A lot of them are running out of money. And at the same time, you have other companies like Hugging Face and others that are successful enough to be homes. Some of these M&A is going to be weird, right? We've seen that happening a little bit with big tech, with some unusual
a marriage
examples.
of necessity rather than choice, maybe.
Yes.
One thing that's good about summits like these, Bloomberg Tech, by the way, we can go around the room and ask who you're going to be shopping for. That's going to be interesting. but you get all these people in one place. You've also used the time that you've been in San Francisco, because you're up in Seattle, right? Miami, apologies.
Yes.
You've been hiring, you've been interviewing candidates. Is that just a function of the best candidates being here in this city? Or how wide are you casting your net?
Yeah, I think San Francisco is still the heart of technology and AI, right? There's so much talent, so many interesting companies, so many interesting big technology companies being here, that it's important for us to kind of like have a foot on the ground here. We have a team already here, but we're also hiring a community lead for Hugging Face here.
Applications being taken?
Yes. There's a really massive fight and struggle for AI talents right now, with inflation of packages everywhere. But what we're seeing is that when you have a mission that's like interesting to candidates, like with open source, then you can attract really good talents. That's one of the reasons why also we're seeing big tech doing more and more open source, right? If you look at Meta, with all the great work that they're doing on open source.
You keep on, I mean, you've only really mentioned number 3. You're trying to cajole Google into going even more open source?
I think as long as companies contribute to the world and to the field with open source, with open research, I think it benefits everyone. I think we've lost a little bit this way in the US for the past few years. If you look at AI 5 years ago, most of it was open source and open science. It changed a little bit when some companies started to make money and change a little bit their approach to things. But I think it would be positive for the world to get back to an AI domain that is more open, more transparent, more inclusive.
You asked a calendar date now, by the way, because you told us you're going to announce some news when you're ready.
4 weeks.
Yeah.
We're holding you to
here.
it.
Thank you.
Clem DeLong, joy to have you with us. We're going to let you get to your breakfast, where he's holding court here, CEO of Hugging Face. What a great conversation. Meanwhile, coming up, another great conversation for you. We're going to have so much more from the Bloomberg Technology live event here in San Francisco. The sun is shining. The people are having their coffee, their caffeine. We're going to get you all of the exuberance in a moment. Mr. Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to this very special edition of Bloomberg Technology, live in the heart of San Francisco. All the great and the good of industry movers, shakers when it comes to artificial intelligence, in particular the academics, but the companies behind it, the CEOs, and notably also the investors. And this is an interesting one for the investor base, right? We potentially have a new large language model getting a decent valuation.
Yeah, so I think what we reported last night is that XAI, the AI company started by Elon Musk and which he built out pretty quickly, is closing this kind of mega funding round. $18 billion valuation. The thing is that we've learned, right, over the last year or more, that is not actually that eye-watering a number. The numbers involved are not that eye-watering.
And wasn't he actually raising an awful lot considering an $18 billion valuation?
Yes, I think we've reported sort of up to $6 billion. The thing is that the compute costs are mega.
Yeah.
And I took a phone call this morning saying, look past the cash and start asking whether XAI's got access to the GPUs. Now, Elon Musk has an existing relationship with NVIDIA, Jensen Huang in the Tesla context, but it's good gossip for the Bloomberg Tech event. It's a good thing to discuss in the hallway.
And ultimately, who are the investors? What we've seen, I think, really the rise in 2023 and 2024 has been corporate VC.
Yeah.
Yes, of course.
Or strategic investor.
Yeah, you've got the Sequoia Capitals being incredibly active, who we're going to have Sequoia Capital on a little bit later. But they're more at the seed of the funding, the Series A, Series B. But the amount of money necessary for these large language models means NVIDIA has to be a player or a Google has to be.
And what I heard is that Jared Birchall, who's head of Musk's family office, has been in the Middle East talking to sovereigns. A lot of that stuff going on as well. All right, coming up, we're going to be joined by the Writer CEO, May Habib. Another conversation around artificial intelligence. Someone who's actually pretty straightforward, pretty direct about what's going on in industry.
I've been doing it before it was cool. Look, she was building this business back in 2020.
And I think what's interesting about May Habib, given what we just heard from Clem DeLong, is May's got a bit of cash in the bank, and that might help. Be right back. This is Bloomberg Technology.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Welcome back to a special edition of Bloomberg Technology right here in San Francisco. An event is upon our hands that is all to do with artificial intelligence. And also to continue that conversation right here, right now at the Bloomberg Tech Summit is Writer CEO May Habib, who joins us now, who has been doing generative AI for the enterprise before everyone else got with the program. You built your business in 2020. You've got an enormous chunk of change from Iconic Capital and other key investors. And how does it feel with everyone trying to surge in on the enterprise opportunity here? How are you standing out and making sure that you keep the key like Ubers and clients that you already have?
Yeah, it's actually really exciting to see all of the investment, right? We've been working on this, my co-founder and I, for 10 years, previously in a machine translation startup. And so to see all of this attention is actually amazing. But the way we stand out, I think, is with a really differentiated platform that helps enterprises with the last mile, which is 90% of the work in AI.
May, you've been on the show a number of times over the last 2 years or so. And each time I always reflect on sort of the rate of change for the industry, but also growth of your company. Clem DeLong of Hugging Face just gave us some numbers about the sort of size and scope of how they're doing. He said close to profit or near profit or something like that. But just tell us about your company and how it's doing.
Yeah, I mean, it's been an incredible rate of change. When we started the company, we knew AI was going to be better at people, at reading and writing, and that has certainly happened. We now say if you can write it, you can build it, because AI is not just the technology, it's the way to build new technology. But building AI apps is actually still quite difficult. And so the rate of change of just what we've been able to do, I mean, it's hundreds of enterprise customers, hundreds of thousands of users, thousands of applications that are in production. So a lot of this kind of question around like how you get applications from POC to scale, you know, we've been doing that for years now, and it's just had a tremendous impact on the growth of the business.
You have some relatively new work on models at Writer. Tell us about the kind of the latest and greatest on the tech side of your offering.
Yeah. So over the past few months, we've introduced Vision as a capability into the platform. We've launched Palmyra in 32 languages at really, really high quality, beating human benchmarks, our customers tell us. And next up for us are large reasoning models. So software that writes software, which we're really excited about, being able to go from, you know, work substitution to real work reinvention and orchestration using AI.
At the very start, you said basically 90% of the work isn't just getting the right large language model in the door, but it's implementing it. It's all the other bells and whistles that go to ensure that you get operational efficiencies, that you put it to your own workflows. What are some of the best ways you're seeing it being harnessed? What are some of the worst ways? Because everyone's still waiting for this eureka moment where all of our exuberance around AI actually makes a real difference when we're at the work.
100%. There are 1,500 LLMs, right? If large language...
1,500?
Yeah, I mean, and they can pass the MCAT and the LSAT. So if LLMs were the answer, everyone would have the generative AI program of their dreams, right? But that's not the case. There's so much work to get the data and the context and the workflow from the business user into the application, right? And that's what our platform does. It's this collaborative interface that combines the LLM with all of those building blocks. And that's where the magic is, because the LLMs themselves need so much more context about the business to be able to do what customers need them to do.
You said before that basically large language models are going to be commoditized. The foundational models are going to be commoditized, particularly from a consumer perspective. Where then does the value ultimately end up lying? Because there are so many people trying to fix problems using generative AI. A lot of them are coming to you to try and be bought or helped at the moment, I assume, because they're running out of money themselves.
Yeah, there's certainly a lot of air being sucked out of the room by big tech, right? But there's still a ton of opportunity for startups. Microsoft has to build for the lowest common denominator, right? So individual productivity is very different than team productivity and team workflows. So even though it feels like we're going to go through sort of a big consolidation phase. I do think there's still a ton of opportunity for startups. We have made a small acquisition that we'll announce soon, and I think we'll make others. So there certainly is a real high barrier for entry to come in and serve the enterprise, but it's still, there's so much blank white open space for startups to help enterprises compete.
It's interesting, maybe, that you use the C word, consolidation. I don't think Clem DeLong went as far as using the word consolidation, but I think, you know, you said something a moment ago about big tech sucking the oxygen out of the room. It goes to the open source closed debate. I assume you sit on the open source side, but just weigh in.
So we're kind of in the middle. So our models are proprietary. A bunch are on Hugging Face, so later generations of models. But our latest models are closed source. But by being in the middle, what enterprises really need is the ability to audit, right, and have the transparency around training data and all sorts of things related to the models. They don't really want like the last mile cumbersomeness of necessarily like fine-tuning or running the models themselves is what we're finding. And so like in the kind of sucking the air out of the room, the confusion around what vendors to turn to and how to actually get great applications shipped, that's where I think there's still a lot of confusion in the enterprise.
And I think there's still all that work to be done to minimize hallucinations, to ensure that we're seeing a clarity of where the underlying data is coming from and you're not having copyright issues. Yeah. Give us clarity on your business now. Have you been approached to be bought? Are you remaining independent? Are you raising more money?
So there's a really long, I think, product journey for us to really realize our vision. So I'm really excited about remaining independent. It used to be a year ago that I would say, you know, LLMs are for the drudgery, the work you don't want to do. Today, the capabilities are so incredible, they're as good as us. But the future is work where you get to do the work you want to do and LLMs do the rest, right? Because one person's drudgery is another person's creative passion. And that kind of compelling vision for the future of work, we're not seeing enterprises come up with yet. We talk to hundreds of companies a week, and that really feels missing right now. Kind of executives painting a vision for what AI looks like inside their companies in a way that brings people along. And so there's a lot to do, both in, you know, kind of bringing our vision into the world and helping companies achieve theirs.
Writer, CEO, May Habib, great to catch up here at Bloomberg Tech in San Francisco.
Can I just say, she flies every week from San Francisco to London and back.
That's what we're hearing, the world of the CEO in the world of AI on a plane. Coming up here, we're going to be joined by Stephanie Zhang, partner at Sequoia, for her take on investing in AI startups. Stay with us, we'll be right back. This is Bloomberg Technology.
Morning from our world headquarters in New York, I'm Manus Krenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years.
Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg.
Welcome back to this special edition of Bloomberg Technology. We're back together live in San Francisco at Bloomberg Tech, our annual conference. And here at the Tech Summit, we've got to talk about investing. The first checks into those new and early AI startups. We have a fantastic guest for today's VC Spotlight, Stephanie Jan, partner at Sequoia. You guys are so busy. You are writing lots of checks, but the new companies being founded in AI are not the same as they were 1 year ago, and certainly not 18 months or 2 years ago. Just give us a sort of timeline of where we are now in this industry wave.
First of all, thank you so much for having me, Ed and Caroline. It's an absolute joy to be here. We're at a really interesting time in AI today. 7 years from the advent of the Transformer, 4 years since the advent of the GPT-3 moment. I think 2024 is going to be a monumental year for AI, and here's why. I think this year is going to be a step function leap in digital intelligence, everything from video to AI agents to robotics. I also think that this year is going to be the year we see a shift in the ecosystem to a thriving ecosystem with many winners in the models area across closed source, open source, large models, small models. And third, I also think this is the year we start to see AI commercialization at scale. And at Sequoia, we've been really busy, as you noted. We're highly selective about the companies that we partner with. But this year, in just the first 4 months alone, we've invested in 10 new AI companies, everything from new foundation models to new AI native applications.
I love that you went through the history, like 7 years ago since the transmission model. I mean, it was 20 years ago, just over, that Sequoia wrote the first check into NVIDIA, and now we think of still that company really owning the oxygen in the room and
they've
indeed the
become an
valuation.
investor, right? They're writing checks of their own as a strategic investor.
And I'm interested, therefore, exactly to Ed's point, how competitive is it out there to get those first checks in? Who are you seeing come in? Is it the corporates that are wanting to write checks? Is it VCs wanting to write checks?
It's an incredible ecosystem right now with everyone pouring money into the AI ecosystem. I think it's very much reflective of the opportunity that we see in AI, the large market opportunity that is to come. I actually think that we're still in the very early innings of all of this. Well, you know, it's the classic saying of we overestimate in the short run, but we really underestimate in the long run. NVIDIA's done a wonderful job of being such a critical hold in the ecosystem with hardware driving compute, but also now with so many software tools and the entire developer ecosystem they've built around them. So I think that we're just in the early innings and there's a lot more to come.
We were just speaking with Clem from Hugging Face and indeed May Habib, who highlight the fact that it's really expensive to do this, and NVIDIA chips are a pretty penny. How are you seeing the companies that you back able to sustain the investment they need to make? How do you make sure the checks you write are going in the right direction and not just sort of going into the pool of training money?
Yeah. Well, I think that the classic conventional wisdom is that incumbents with scale, data, capital, and distribution have a natural advantage. And that's absolutely correct. It also costs a lot to build these models because of compute and for AI talent. But I also think that there are so many nimble ways for a startup to compete. Specifically, I think the next leap is really around, one, high-quality data. Okay. Specifically, high-quality labels of data and targeted domain-specific data. Second, it's really about what you do with that data. Reinforcement learning with human feedback, I think, will really shine in this next era. It's an idea derived from reinforcement learning, but here an agent actually also learns on the fly with human feedback. And that's what's so brilliant about ChatGPT, for example. And finally, I think that you really differentiate not just on model performance, which is where all the capital goes into, but it's also around product distribution and the entire product experience that you offer to the end customer.
You use the word incumbent. I think we should probably talk about who those incumbents are, because the point that May Habiba Writer made, and to a certain extent Clem from Hugging Face, is that big tech, and I think we're talking about Alphabet, Microsoft, in the first instance, are sucking the oxygen out of the room. From a capital perspective, a talent perspective, you invest at the pre-seed and seed stage. Do you find that to be true?
Well, I think that incumbents absolutely have an advantage, as we just outlined, but I also think that new startups have a shot. Scale.ai actually recently released a survey last week where they interviewed thousands of developers on their most popular models. And the ones that actually came into light were GPT-4, GPT 3.5, and Gemini as the most popular models used. But we're also starting to see new players come into play with models that are just as competitive in performance. I'm really excited about the open source model ecosystem enabling many more new players to come into play. Llama 3, for instance, is so powerful. The new 8 billion parameter model is a longer trained, small model that I think will become a really powerful building block for new developers to build new applications on top of and to build new models around it. It's going to drastically reduce the cost of what it takes to build new experiences.
We are increasingly talking about Meta and its competence in building large language models. You speak highly of them. Where do you see them? I think Zuckerberg said on the call last week, we want to be the world's leading AI company. Where are they in that journey?
I think that they have an incredible advantage, not just because of the capital that they're willing to pour into play, but also because of the entire treasure trove of data that they hold. All this proprietary UGC content that they can really use to train their models. One of the things I'm really excited to see them enter the scene with this year is a new generative video foundation model, similar to what we saw with Sora and OpenAI. To me, the most powerful thing that unlocked was that the methodology we take for building large language models and digital intelligence works for video as well. You take a diffusion transformer model and you just scale it with enough video data and compute. And Meta has a wonderful advantage given the entire treasure trove of content they have to compete in the ecosystem. And then what they're doing with Llama 3, I think, is game-changing entirely. It opens the playing field for everyone, themselves, new startups, lowering the cost for a thriving ecosystem with many winners.
Come back when you've got more checks that you can announce in that thriving ecosystem. Such a joy to be here with you.
Thank you so much for having me, Caroline.
Thanks for stopping by. Sequoia partner, Stephanie Jan. Great to have some time. Meanwhile, coming up, look, don't go anywhere. We've got more conversation to be had. Actually, the people working within some of the big companies leaning into AI, but also how it makes a difference into, well, the way you get your things delivered. Udit Madan is going to be with us, Amazon's Vice President for Worldwide Operations. He oversees more than 1 million individuals at the age of 37. His Bloomberg Business Week's 2024 Tech Ones to Watch. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
Welcome back to this special edition of Bloomberg Technology. The heart of San Francisco, big event upon our hands. And every year, in fact, Bloomberg Business Week releases in tandem its list of tech ones to watch. Look, these are the startup founders, the big tech managers, the, well, key investors as well, who are playing a big role in shaping tech's future. And joining us now is one of these ones to watch. I'm pleased to welcome Udit Madan, Amazon Vice President for, of course, the worldwide operations side of the business. Your first interview since taking on an enormous role of more than 1 million people that you manage. The focus of getting my package to me in the swiftest way, most cost-efficient manner as possible. Can I just ask what your day looks like? What does a day in Udit look like?
Well, first, Caroline and Ed, thank you for having me. It's a privilege to be here. You know, for me, really my day starts fairly early in the morning, but it starts with thinking about the team I've got. We've got a very, very broad team all around the world. We've got 4,000 different locations that we operate around the world, and really it's focused on how do we continue to innovate on behalf of customers, but do it in a way that puts safety and people at the forefront. And so my day is really focused on innovation across 4 different spectrums: safety, really the customer experience with delivery speeds, innovating, especially with what's happening with technology, finding new ways, whether that's through robotics or operations, to make things more efficient and drive new customer experiences.
When you're talking about the technology, we're talking about everything from the fleets, right? So there's a transition to sustainable energy in the fleet context. We're talking about robotics in the fulfillment centers, and dare I say AI in tracking the data. What's the biggest investment focus for you right now in technology rollout?
We've got technology all across our operations, and there's really 2 things that I would maybe thematically talk about. One is we do have a lot of investments in automation and robotics that are going on, especially with how quickly things are accelerating with generative AI. We have investments on really novel foundational models that look and use the high quality data that we've gathered and sourced as we ship tens of millions of products every day, and those are going to help make some of those robotics solutions more generalizable as well as make them more efficient. And the second is we've been working on a set of really inventive robotic solutions over the last few years that are finally reaching maturity and scale, and will start to roll out starting this year. Both those are really exciting and will be transformative for our operations.
I mean, you've got to be inventive, because Andy Jassy is asking you to focus on costs. But I'm sure the innovation in a way does, longer term, once you made the investment, strip out some of the costs. But ultimately, does that come at the sacrifice of labor? How do you talk to those people that you're so keenly focused on to ensure that they feel that they're being augmented, not replaced?
the best thing I can talk about is our history. We've deployed 750,000 robots over the last decade across our operations. We've done that while creating hundreds of thousands of jobs. And what's really interesting, and not a lot of people know, is we've created dozens of new class of jobs, skilled jobs, technical jobs. And what we've learned in that process is that one of the most important things that you can do as a company in this world of generative AI and robotics is to really focus on investing in employees. So we've launched 2 different programs. One is a 2025 upskilling pledge that really helps train people for this new workplace of the future. Yes. And an AI Ready program that's generally available to everybody that's really focused on investing in helping provide AI skill training to over 2 million people. So really focusing on people alongside the investments we're making in generative AI and robotics.
We just have 30 seconds. What's your one personal goal for the year, something you want to achieve?
For me, there's more than one, but I'll try to answer it quickly. The first and the highest priority for us is safety, and we want to be the safest workplace across the industries we operate in, making measurable and really remarkable progress in that area. I want to continue to invest in that. And the second is to continue to improve the convenience for customers, and delivery speeds is an area of focus.
Udit, congratulations on being one of the key ones to watch. Phenomenal, the amount of people you manage, young age that you are, Udit, Madam. We thank you, Amazon Vice President of Worldwide Operations. Meanwhile, from ones to watch of individuals to everything you've got to watch coming up, because this is going to be an amazing set of conversations. I'm going to be speaking with a key chip leader, of course. You're going to be speaking about the future of technology. Who have you got lined up?
Yeah, I'm going to talk to Tom Oxley of Synchron, and I'm going to talk about brain implants and what the right method of putting a electrode into one's brain is.
I love
Casual.
that. Casual perspective. Renee James is joining me, Ampere CEO. Look, this is the question that, having just spoken with Renee, the other Renee in chips of ARM, where is the market share being taken by these newer players, taking from AMD, from Intel, even potentially NVIDIA?
Thank you so much for joining us on this special edition of Bloomberg Technology. It's great to be back together in the field, but we actually have a full day ahead. So many great guests. Stay with us. Thank you for tuning in. From San Francisco at Bloomberg Tech 2024, this is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome to Bloomberg Markets. I'm Shonali Bassick. The latest U.S. jobless claims data adds to evidence that the labor market is cooling, paving the way for the Fed to possibly cut rates this year. Let's get a quick check on the markets. The S&P 500 floating above 5,200, just below that mark right now. But of course, we're seeing new highs on the day of 0.2% higher. You're not seeing that same love for the NASDAQ 100 here. About flat on the day, trying to break back into green territory. The Dow Jones Industrial Average still in the green, and as we've been talking about, the VIX relatively calm. Let's flip up the board, look at the bond market here, because of course this is where all the interesting action has been. We have that 2-year yield still above 480, but you are seeing the direction of travel downward in yields. You are seeing it about 1 basis point lower, but it is above what we saw in the 10-day low of 470 here, so still well above that mark. The 10-year yield below 450, standing at 448. New York crude at 79. You still have that barely up on the day, and gold spot still on the rise. Let's highlight some individual movers here. Roblox plunging on weak bookings. Forecast for the gaming company, you have it now up, or down rather, more than 20% on the day. Just a tough tape for Roblox there. Airbnb also posting a weak outlook for the travel sector. And the real estate firm Equinix says its internal investigation into accounting practices has been closed. So Equinix up about 11% here on the day. And of course, much moves abroad as well. The Bank of England held interest rates steady, but sent its clearest signal yet that it was closing in on rate cuts, with Governor Andrew Bailey indicating that markets were underpricing the pace of easing in the months ahead. Earlier, Bloomberg's Francine Lacroix sat down with Bailey about the central bank's next steps.
Our forecasts are conditional on a number of things, but one of the things that obviously are conditional on is we use the market curve to set them up. So I think it's important that if we find that a forecast with the market curve produces a best judgment, which has inflation below target or above target, but not at target at the sort of horizon, we say so. We say this is where we got to. Best collective judgment is that. Now, it follows, I think, that, and this is the comments I made earlier, that what we're saying is if, and the if is of course critical here, if the world evolves as that forecast suggests it was, well, probably the case would be there for a less restrictive path of policy.
So is
it's
June
all conditional?
Everything is conditional. Is June a live meeting?
All meetings are live.
So is June likely?
That's a different question. That's different. Look, I think the key points I would make is that we have changed our view on the likely persistence of inflation, on the second round effects. And I think it's good news. We think there's evidence there to suggest they will be less pronounced than we thought they would be. But that's a judgment, and for me, I'm now looking at particularly these three key indicators: services inflation, pay, and the quantity side of the labour market, to really judge this persistence question, how it will evolve.
Governor, there is an assumption, looking at history, that once you cut, you continue cutting. Now, without prejudging what you'll do, can you give us an idea of how you see the cycle different to 2009?
One thing I would say about this, which is sort of quite interesting, and it's something that we looked at during this round, it's quite interesting in the history of the MPC that most of the cutting cycles in inverted commas, have actually been prompted by some sort of shock or other, rather than being what I might call a natural cyclical sort of, we've reached the top and now we go down the restrictiveness curve. So we don't have a lot of, I would just caution, there isn't a lot of sort of history really to...
So what you're telling us is because you're not cutting in a recession, it could actually be one and done?
Well, I think that would be unusual. But I would say, as I said earlier, nothing's settled, there are no fait accomplis, nothing's ruled out.
Governor, what can you tell us about the play between, of course, interest rates and QT? Right? Some may find it confusion because they're pulling in different directions.
So the message we've always given with QT is that QT operates in the background for us. We don't think it has large impacts in terms of markets. But the other point, and this is really the critical point, when we sit down to decide on what the right interest rate setting is, we take into consideration everything, including markets, obviously, and markets will have absorbed, if you like, and taken into account the impact of QT. So, in other words, QT is always there, if you like. If there is any effect from QT, we'll capture it because we'll capture it in the movement of markets, and then we will set bank rate to reflect that.
But you don't think it's confusing for markets? This kind of
I don't think so, no. Don't think so.
So you're not expecting it to end it before the end of the year to make sure that there's no confusion in what you're trying to do with the economy?
There was, to my mind, any difficulty if we get to the point when we're going to cut interest rates to have QT going on as well.
And here in the U.S., signs of cooling labor markets are fueling more Fed rate cut bets. Mike McKee joins me now from Bloomberg with more on this. We saw those jobless claims come in. They were higher than expected. Of course, there are some extraordinary things going on, some extraordinary moments with school recess as well. How do you read into that?
Yeah, this is not really a surprise if you follow jobless claims on a year-to-year basis. The New York City Public Schools send their kids out on their spring holiday break, usually in April, which is what happened at the very end of April. And so the 1st of May numbers reflects the thousands of New York school workers who can file for unemployment when they're on vacation. And so we got a big jump up, probably go back down next month. 231,000 was the number. It's well ahead of the year-to-date average. Continuing claims also rose a tiny little bit, but they also are below the year-to-date average. So it doesn't look like a deterioration in the labor market. What's really going to matter, Shonali, is next week when we get PPI on Tuesday, and Wednesday, CPI and retail sales. And also Tuesday, we have Jay Powell speaking in Europe in a moderated conversation, which means he could say just about anything and make news, except for the fact that he won't have the CPI or retail sales numbers, and those are the ones that are really going to matter to the markets. So at this point, it's hard to say whether we'll get any change in the odds of a Fed rate cut or not.
Mike McKee, we thank you so very much for keeping an eye on all the data. Of course, the big stuff is really next week. Up next, Affirm CEO Max Levchin is joining on the health of the consumer and how buy now, pay later is changing shopping habits. Of course, this shadow market for loans has been catching a lot of investors' attention. We're going to ask him about it next. This is Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Yes, we do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a character.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets, and I'm Shonali Bassick, and we are going to talk about buy now, pay later, because consumers have embraced it at scale. It allows them to pay for purchases in installments. What's not as clear is how many of these loans out there are perhaps under more stress. Listen, a recent survey conducted for Bloomberg News by Harris Poll found that 43% of those who owe money to BNPL services said that they were behind on payments, while 28% said they were delinquent on debt because of spending on those platforms. We're going to discuss this with the firm CEO, Max Levchin, who just reported earnings this week, gave a really good picture, big picture here on what delinquencies look like for you guys. But why do you think it is that so many customers are reporting that much stress on a broader scale, as the poll shows?
I'm not sure I can speak to the industry, but obviously a firm is built on the idea of underwriting every single transaction, not charging late fees, which is important not just because it's such a nice thing to do for the customer, it's also a fundamental alignment between us and the borrower. If the borrower does not pay us back, we cannot benefit. Like, we will lose money if they don't pay us. It's as black and white as that. And so, yes, we may be an outlier in a sense that our customers outperform relative to what sounds like a fairly dark-sounding survey, but also public. So our numbers are in plain sight at all times. We just printed our last quarter yesterday. Our delinquencies were ever so slightly down year on year, and sequentially it's still 2.3%, as it's been for quite some time, and doing just fine. And so I think the rumors of BNPL's difficulties are greatly exaggerated from my point of view. Obviously can't argue with survey data. I can't argue with the Bloomberg story on the phantom debt, which is basically mathematically inaccurate in its following sense. So vast majority of installment loans are reported to credit bureaus. We have been since the very beginning of our time as a company, and installment loans in general are required to be reported, and that's what everybody does. Paying for is typically not reported. Apple just launched their furnishing. It's great that they led the way. I think it's a really healthy thing for the industry. We'll certainly follow them. But generally speaking, right now, majority of pay in 4 loans are not reported.
But here, on that note too, pay in 4 loans you said are not reported. So, I mean, that is a fact. And so if you have that pay in 4 loans are kind of operating outside of the traditional way credit reporting system, how could you have comfort as an investor in the broader credit markets that there aren't a significant amount of stresses in that system? So let's do the math. The industry volume for pay in 4, the entire industry, was $50 billion last year. The weighted average life of a pay in 4 loan is 3 weeks. So 52 over 3, just over 17. $50 billion divided by just over 17, that's in the $3 billion range. $1,100 billion, or $1.1 trillion of overall outstanding credit card debt in the United States. Squint, that's 0.3%. Are you worried about phantom debt in the scale of 0.3% of overall credit card world? Credit cards revolve, they charge late fees, they have all sorts of hidden charges that are built in. With pay in 4, you never pay interest, or certainly never in our case, and never in the industry case as well. There is no revolving, and it is just tiny. And so the BNPL pay in 4 world, yes, it should report for the health of the consumer, for them to build credit, but it is not a systemic risk. Do you think that there should be broader kind of reporting standards here for the pay in 4 model? There are already emerging new standards for pay in 4 reporting. The entire industry united behind Experian and Apple as they stepped forward and said, hey, we need to bring this to the level that installment loans, monthly loans are. And there are several industry associations that are working on standardizing. Like, all of us are going to report pay in 4 loan, full stop. It is coming very soon. Everybody wants to make sure it's right, because when you misreport someone's credit, that's a far worse offense than not reporting it. But the industry trend towards reporting
every kind of loan in BNPL is absolutely real.
Do you think that's enough to kind of put to rest the fears around this phantom debt worry that a lot of investors have?
It certainly should be, just given the tiny scale that it represents and the fact that everyone is going to report it. So again, ultimately, my responsibility is to affirm shareholders. Our delinquencies remain both very publicly visible and quite benign, and we intend to keep it that way.
To your point on delinquencies, you said that they've actually marginally decreased. And if that is true, I'm curious what that means about your underwriting standards. By and large, we've seen a lot of credit card companies, traditional ways, say that those delinquencies have been increasing. They're projecting increases. So have you had to tighten standards to address this current economy?
Not very recently. We've generally held our underwriting standards about the same. That said, the benefit of underwriting every single transaction is you don't have to make these super long-term decisions and prognostications about the economy. We look at each borrower separately and ask the question, all right, given what we understand about your financial situation right now, both within and outside of a firm, is this a sane decision for you to borrow money? Given that we will not compound your interest and will not charge you late fees whether you're on time or not, we better get it right. So our underwriting standards are necessarily very, very tight because we want to make sure we get paid back. And we also want to make sure the customer is able to pay us back.
There are a lot of concerns about the state of the consumer right now more broadly. Of course, you feel that among your investors. You feel that among merchants. Shopify this week, when they reported, you saw Wall Street really latch on to their guidance and have some fears about the direction of travel. When it comes to the consumer, you saw the firm stock really feel that concern and sympathy. What would you say to the strength of the consumer right now and how it holds up in this kind of higher interest rate environment throughout this year? Throughout this full year, 2024, not just the fiscal year?
So, meteorologists and economists are the only people who get to keep their jobs whenever they're wrong, and they're wrong all the time, judging by the weather in New York. But I grew up in Chicago, where weather changes all the time, and I'm quite prepared for any weather. I don't know what's going to happen to the U.S. consumer. Right now, they're shopping. They're actually shopping reasonably well. For a time, we saw a giant demand in travel because people were tired of being cooped up in a post-pandemic world and were trying to get out of town. I think that's normalizing a little bit. There's still plenty of healthy demand. Every flight that I take, and as you know, I travel way too much, is always sold out, so there's lots of people traveling. But I think we will see a lot more as the summer gets through, as the holiday season sales come in. Inflation is real. I think that's probably the far more important thing from the sort of consumer health, consumer spending point of view. From a firm stance, the Fed rates are not an important contributor to the business. One of the things that we said for a year and a half is, so long as the Fed is careful in moving the rates, we'll be just fine. You saw us post quarterly numbers again yesterday. Our profit margin measures remained very strong, stronger than perhaps some of the estimates, in the world of cost of capital changing quite significantly over the last 2 years. We are not super dependent on a short-term rate changes, which is a nice place to be. Consumers are very dependent on inflation, and I worry what happens to the economy over a long term if the prices don't normalize. But right now, U.S. consumer is healthy.
You've always said to me before that you shouldn't be revolving on a cup of coffee. I think we can also agree that you shouldn't be paying for on a cup of coffee. Do you think that it's such that inflation is so hot that consumers are trying too hard here to put money on credit in all its different forms?
So another important and perhaps little known fact about paying for and certainly monthly installments, all of us, every single provider, not just a firm, has what we call a floor of our transaction sizes. So at least as far as I know, no one has ever paid for a cup of coffee in paying for. I don't think it's actually possible. We would
But everyday goods, they're groceries, let's say.
Well, so if you're spending $50 on groceries, you probably, if you're thinking that's too much, I want to pay it over the next 6 weeks, you should reconsider your choice of grocery provider. But if you're spending, on a Passover Seder, and it's a couple $100 because your family's in town, that's not an unreasonable thing to finance. And so I'm sympathetic to a use case. I'm not super sympathetic to sort of the daily, I want to pay for a $20 thing. I think that's unhealthy behavior, and it signals something else in a person's life. But generally speaking, card floors, transaction floors are an important self-enforcing guard against people overusing or abusing these kind of products. I do think that revolving on cup of coffee or grocers or anything that does not survive the useful life of an item that is shorter than the revolving period is a profoundly bad personal economic idea.
Max, we have to leave it there. That is Affirm CEO Max Levchin. We thank you so much for your time and answering our tough questions here about phantom debt that may or may not be out there. Still ahead, Bob Fiordi of RealTerm talks his company's growth in the industrial commercial real estate market. Of course, a very highly watched market at this point in time. We're going to talk about that next. Stick with us. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking?
Yeah.
I mean, like, what's that about?
We're not forcing everybody to, be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
This is Bloomberg Markets. I'm Shonali Basak. Let's dig into the risks and opportunities we're seeing in commercial real estate, specifically industrial.